Good morning, everyone. It is Tuesday, January 17th here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Inez Ferre. We're going to be hearing from Julie Hyman and Brian Sozzi. You're seeing them in Davos, Switzerland. They're live in living color on your screen. But first, before we get to them, we got to take a look at some of the market action on this busy week. They look bundled out there.
Yeah, they do.
We're going to check in to
backdrop.
see perhaps the weather report as well coming up. But taking a look here at the futures this morning, we're starting on the Dow Jones futures. You're seeing that down by about 0.4% here, and that's kind of mirrored across some of the other major averages here in the U.S., where you've got futures sliding this morning. Nasdaq futures, that's down by about 0.3%. S&P 500 futures down by about 0.2% right now, Inez.
Yeah, and we're also taking a look at the U.S. dollar index because we have been watching the dollar index and how this is also affecting assets overall. This is the dollar against a basket of currencies, and so we're seeing it at just 102.12 right now. Also want to point out where we're at in pre-market with the sectors, because we have been seeing, as you mentioned, movement to the downside after we saw a rally last week, really. We ended last week in positive territory, but right now we are seeing some of the sectors, financials, down 0.4% after Goldman Sachs reported earnings, Morgan Stanley as well.
Absolutely. We're going to get to some of those bank earnings, but first, the World Economic Forum kicks off today for its first in-person meeting after a 2-year hiatus. World leaders, business titans, and politicians alike are all gathered at the event, packing their schedules with high-level meetings, panels, and room for deal-making. This year's event comes as the world faces its cloudiest economic and geopolitical future in years. And so with that picture, let's go to Yahoo Finance's Brian Sozzi and Julie Hyman. They are on the ground over in Davos, Switzerland. Guys, you look a little cold, but you're looking good. You still look great.
Hey, Brad, the weather here is snowy and about 10 degrees. Back to you.
It's not that cold up here.
Oh, no, it's okay. It's actually
Wait,
warm.
it's actually sunny, so the sun. I'm going to put on my amateur meteorologist hat and say the sun's bouncing off the snow, and it's actually, I don't know.
Sounds like a stock talk, Julie.
It's not that cold right now, so
but
I'll take it while I can get it.
Importantly, Brad and Inez, the crowds are back here at the Davos, at the World Economic Forum in Davos. You know, I went to the one in the summer. The crowds weren't what they are. It didn't feel like a typical Davos, but the crowds are back here. We were just chatting up with Brian Moynihan, Bank of America CEO. We'll hear from him later in the show. A lot of executives that normally would attend this are back. And they're all kind of depressed, Julie. A little depression in
There are a lot of executives here. There aren't necessarily as many world leaders here. We did have a Chinese Vice Premier Liu He getting some headlines talking about that the property sector in China is going to continue to be weak, but surprisingly not as negative on the broader China economy. And I would say that's sort of the nuance of what we're hearing more broadly, that there is definitely caution being expressed on the economy. I mean, I know you were looking at the PW survey to that effect, but the world is not ending, right? That's not the vibe that you're getting, even if the world is facing a lot of different issues.
And of course, the China Vice Premier, surprise meeting with Treasury Secretary Janet Yellen. So that happened this morning. We saw Janet Yellen walking into the Congress Center just moments ago. But you're right, Julie. So that PwC survey, 73% of CEOs surveyed noted they see an economic downturn sometime this year, or a recession. A good part of them, too, which I have to giggle at this a little bit, they don't see their business being around in 2 to 3 years, which is a big red flag. You know, when I talked to Brian Moynihan, we'll have that full interview soon, he's calling for a mild recession. Now, this is what we heard from a lot of the bank CEOs last week, but he sees a mild recession this year, but maybe things start to reaccelerate in terms of growth in 2024 and then 2025.
And, you know, we were just chatting earlier how when we're here, it definitely feels like you're in a bubble, right? Yes. We know that there's a lot of news still happening in the U.S., earnings-wise and otherwise, and yet there's sort of this, I don't know, insulated feeling.
Are the markets even open? What are they doing? Is pre-market?
No,
I'm just totally detached.
The markets are not open yet.
Not open.
We're 6 hours ahead of you, so I guess that's why he's confused.
Sure. So I was just taking a look at that survey and a little under the hood on it. There's 60% of CEOs are saying that they won't be reducing their headcount. So I mean, what do you make of that? We have seen layoffs in the tech sector, but the tech sector has also hired a lot during the pandemic. So what do you make of that stat? And also, I know that you had mentioned even the tech sector in your morning brief meeting.
Well, thank you for reading that morning brief newsletter, Inez. I really appreciate it. Oh, well, Bank of America CEO, I'm going to keep mentioning his name. I'm going to keep name dropping because he was one of our early interviews here. He's not expecting any mass layoff announcements. Of course, we had Morgan Stanley, Goldman Sachs sending people pink slips. None of those happening at Bank of America. And, you know, I was talking about this, Inez, with Julie just moments ago, that there appears to be a multi-speed recession, or two different stories here. One, you have a lot of companies laying people off, like tech, like in Wall Street investment banks, but a lot of other companies taking those laid off of workers and either hiring them, and then in addition, also keeping the workers they have, almost supporting them.
Well, not even sort of multi-speed among different companies, but even within the same company. We were just talking to Martine Ferlong, who is the Mercer CEO, the world's biggest HR consultancy, and she said what they are seeing is even within a company, whereas in past recessions or pre-recessions even, you would have mass layoffs across multiple different functions of a company. Now they are very targeted in areas that are not seeing as much growth, so that companies are seemingly being much more strategic in how they are cutting people. So that's how that stat that you mentioned, Inez, does seem credible, given the sort of different nature of how layoffs are happening right now.
We look forward to the rest of the morning with you guys from Davos. Thanks, guys. See you soon. And big banks earnings continue to roll in with Morgan Stanley and Goldman Sachs, both reporting this morning. Goldman Sachs posting a huge miss on profit due to a sharp drop in revenue from its asset and wealth management segments, as well as higher credit provisions and steeper operating costs. And just taking a look at some of the what came out of Goldman Sachs this morning, Brad. Just looking at, first off, the stock reaction, because we are seeing the stock that's lower as opposed to Morgan Stanley, the stock was higher. But taking a look under the hood at what they talked about, their return on equity that was hit by it came in at 10.2%. For 2022 and 4.4% for the quarter, falling below a target of 14 to 16%. And something else that we just want to note also when it comes to Morgan Stanley, for example, we are seeing with equity underwriting, that was down for the third quarter, which obviously was not great. Actually, this is Goldman Sachs, by the way, that I'm still talking about. And also, just looking at some of the commentary from analysts, these results were widely expected to be awful. Goldman Sachs' fourth quarter results were even more miserable than anticipated. That's according to one analyst. The problem that he saw was that expenses shot up 11% while revenue tumbled.
Yeah, it's really some of the divisions. And as you were breaking down kind of the results for each of them, I'll start with Goldman here, because they noted global banking and markets, $6.52 billion for the quarter. And that was 14% lower than the fourth quarter of 2021. If there's anything that you're looking at across both of these banks here, is that they did see, especially in the investment banking divisions, some of those year-over-year declines. Investment banking actually over at Goldman Sachs, that was down 48% versus the strong fourth quarter of 2021, which they noted. And so even within that, you think about Goldman Sachs and what they saw in those particular divisions that were lower year-over-year, then pair that with what we saw from Morgan Stanley's earnings that came out. And Morgan Stanley, even in all of those segments that they were reporting for, investment banking, once again, common denominator, that was down in revenue, at least by about 49% from a year ago. Equity net revenues, they were down by about 24% from a year ago. But if you're looking for a bright spot, that came in the form of fixed income. Those net revenues were up by about 15% versus last year. Last year, of course, 2022, a strong period for fixed income. But then additionally, you think about what the wealth management looked like. And wealth management actually saw one of its best quarters ever for Morgan Stanley. So we'll continue to watch both of these companies going into the opening cross here, but seeing some differing reaction, at least with about 21 minutes until the start of trade here in the U.S. But also staying abroad, let's talk about China. China's economy had one of its worst years in decades in 2022. COVID lockdowns and outbreaks, they weighed on growth, and its economy grew 3% for the year, falling short of Beijing's target of 5.5%. Now, besides 2020, this was the country's most disappointing showing since 1976. And really kind of looking at some of the other metrics here, when we talked about the full year GDP growing 3%, that still was above estimates. However, this was still coming at a time where there was, for much of the year, the zero COVID policy or stance that the country was rolling out and continuing to have as one of the kind of blanket policies, and that impacting everything from production to the ability for consumers to go out and shop. And so all of that kind of put together, you really think about some of now the stimulus mechanisms that they're trying to implement in order to spur or at least reinstigate some economic growth in this year, 2023.
Yeah, and there seems to be two sort of narratives when it comes to China and the reopening. There are those narratives which are bullish, which say that there's pent-up demand, there will be pent-up demand for services. You even had Morgan Stanley that recently said that Chinese equities are bullish, that Morgan Stanley sees this year's expansion to 5.7%, where the consensus was 4.8%. But then you have these now sort of warnings about expectations for this year that perhaps it'll be a little bit bumpy, with Moody's Analytics saying that China's 2023 will be bumpy. That's because of new COVID waves. That's because of the residential property market that you were just mentioning. Also, weak global demand for its exports. So while the world is looking at China to sort of lift up the world economy as it reopens, China also has there's a little difference of sort of a narrative on how that reopening will take place, how bullish it will be for this year for China.
Well, you've got some investors that are bullish perhaps on that rebound. Ryan Cohen taking a look under the hood at Alibaba and really saying, you know what, I'm going to take a significant position within Alibaba. And we're tracking Baba shares here this morning as well in the pre-market. Taking a look at here on my screen as you've got them pulled up. They're flat just barely to the upside there. But Ryan Cohen and any stake that he takes in some of the more noted e-commerce plays, or how he's shifting some companies more towards e-commerce, thinking of you, GameStop, that is noteworthy, just given the fact that this is a founder that has been so kind of tech savvy, looked at for some of kind of the e-commerce diligence that he's brought to the fray for everything from pets all the way now to more gaming, and then additionally just seeing where there could be an opportunity within Alibaba, especially as that market specifically, perhaps especially in the equities market, is experiencing more of that outsized downturn, or has already been in that downturn, and is now banking on perhaps the shares to come back. But then additionally, and take a look at the past 3 months, Baba shares have climbed back by about 56% over that point in time too.
Yeah, and anything that Ryan Cohen touches, there's certainly a lot of attention that's paid to it, especially by retail traders. Coming up, why our next guest says 2023 will be the year of the bull. We'll discuss next. Stay with us. Despite the stock market decline in 2022, some of Wall Street is optimistic on the year ahead, with our next guest saying 2023 will be the year of the bull after we saw the year of patience, frustration, and quality in 2022. Heritage Capital President Paul Schatz joins us now. Paul, so great to have you with us. We often hear from so many bears about this year and what will be coming up. Give us your thesis for the year of the bull.
Good morning. Good to be with you guys again. Look, you come into the year, you've got inflation, an over-aggressive Fed, and a weakening economy. You know when that was also seen? That was also seen heading into 1995, which was the single greatest investing year in the modern era. I'm not calling for a 37% rally this year, but look, we come into the new year, everyone is lined up to I think we could have a mild recession, but my argument is that the market went down 20% on the S&P, 30% on the Nasdaq for a reason. It didn't do so because things were great. It did so because the market saw economic weakness. It saw the Fed raising rates repeatedly. You come into a new year, portfolios are positioned so far to the negative side. It's the third year of Joe Biden's presidency. Since Germany invaded Poland in 1939, we have not had a down third year of a presidency. Back-to-back down years have only occurred 3 times since World War II, 1974, 01, and 02. The odds are heavily stacked in the bulls' favor. You have the single worst year of the bond market history and the longest decline in history. High-yield bonds have never been down back-to-back years. I mean, I feel like everyone positioned like 1994, like 1981 for the absolute worst. Who's really left to sell?
And so, Paul, even with the bullish outlook here, there's so many company CEOs, even from the PwC survey, even in statements, business updates that have started to pour in early this year. It's clear that some of the CEOs and their executive teams are saying, hey, we just need to rip the Band-Aid off now and let the markets know exactly what we're expecting and how much it could impact our business. And so to what extent do you believe that there still is some downside potential or risk, given the fact that you do have CEOs saying, you know what, we need to be transparent about the risks that are prevalent and present in front of our business?
Your comments are spot on. I don't think the conclusion of the CEOs is spot on. Look, at the beginning of 2009, go try to find a single positive forecast from anywhere in corporate America. Market went down the first quarter and the end of the year up, 25%. I think CEOs are so scared these days because they're being graded. It used to be on an annual basis. Now they're being graded on a quarterly, almost monthly basis. So they're trying to set expectations low, plan for the worst, hope for the best, whatever adage you want to use. And we all see the economic weakness, but it doesn't mean this deep and long recession is coming. I don't think it is. So I take what they say. The most important thing is this. We know we're going to get pre-announcements right now through next month. We know we're going to see companies lower guidance. If the market doesn't hit those stocks more than a couple of percent, I would tell you with highest conviction, the market's priced in whatever mild recession or economic weakness we're going to get in the next 3 to 6 months. Again, markets trade on economic activity 3 to 9 months down the road. So the CEOs are starting to feel it, see it now. But the markets have already seen this play before, and markets are looking ahead. And I'll say this as well. For the techno wonks out there, you have an absolute surge in the number of stocks going up versus down off the December low. And now you've got the up volume to down volume, again, getting a little wonky. And all that means is this for the average investor. It's like a rocket ship taking off. All right. Once the rocket ship takes off and reaches that escape velocity, it continues on its own. And that's what these thrusts are in the market. You've had this explosion higher, and that should continue on its own. Go try to find really bullish people strategists on Wall Street. Everyone's talking about we have to go down to 3,000 or 3,200 first. That's nonsense. And even if I'm wrong on the timing, you could have a 10% decline in the first quarter? I don't think so. I think it's going to be a front-loaded year. But even if I'm wrong, by the weakness in the first quarter, stocks still run 20% from there. I think it's year of the bull in stocks, year of the bull in bonds, year of the bull in gold. Buy all into weakness. You'll be happy in 12 months.
So buying the weakness. Tell me, what are you looking at? I mean, what should investors be buying? What stocks, what sectors do you feel will outperform?
Well, for sure, the market's telling us right now, if you look at leadership right now, market's telling us that, if you want to take a little risk, I like semiconductors this year and biotech. I'll be alone on my island. That's okay. I like being in the vast minority. But the market's told you already, financials, materials, technology, the risk on sectors. One sector that I'm not extremely excited about this year is energy. It had two monster years in 2020 and 2021. And I think it's time you pull energy off the table, pull staples and utilities and the defenses, put them aside, maybe second half of the year, maybe 2024. But I think you've got to stick with the risk on sectors and indices. Small caps are leading. A lot of good things are happening if people just open their eyes, look at the data in the market, and not listen to the narratives out there. It's easy to spin a narrative on Wall Street.
Heritage Capital President Paul Schatz. Paul, always a pleasure to get some of your time and insights.
Good seeing you guys. Thank you.
Good to see you too. Coming up, everyone, EV sales, they're hitting new levels. We're going to discuss that. Plus the opening bell on Wall Street. That's coming up next. Still some time till the opening bell. Let's take a look at a few trending tickers. We're taking a look here this morning at Tesla, NIO, and other EV makers. They're in focus after new data provided by LMC Automotive shows that electric vehicle sales in 2022 represented nearly 10% of all new cars sold, as strong growth and demand to go to fully electric. That continues to rise here, and really breaking down some of the numbers here from LMC Automotive and EV volumes. Manufacturers, they continue to pump out some of the new EV plays here. It's more than just kind of Tesla on the both luxury and mass market side, as we had seen last year, not just and over the past 2 years, new companies making their fray into the public equities market, whether that be Rivian, whether that be Lucid, but now it also comes in the form of some of the broader international competition. And so this 10% figure that we've seen in 2022, it's actually an increase of about 8.3% representation that EVs made up in 2021, and particularly here, consumers in that switch from gas-powered vehicles, they're really going to be looking for more of the build-out of this network, and it's estimated that it's roughly $90 billion that needs to be invested to really build out the charging station network and infrastructure here in the U.S.
Yeah, and that's going to be critical for the adoption of electric vehicles, but also just the fact that Europe and China have been the leaders when it comes to adoption of EV vehicles. For the full year, EV accounted for 11% of total car sales in Europe and 19% in China. And it makes sense because China is a place where electric vehicles are made. You have big electric vehicle companies that are making those cars there. And then you also have Europe, which is not energy, which needs energy, is not energy independent. And so therefore Europe is the leader when it comes to electric vehicle adoptions. And one interesting tidbit point is that Volkswagen's head of its China business was talking about the China sales and how China could soon reach a point where sales of conventional vehicles are permanently decline, and vis-a-vis plug-in vehicles. So it really seeing China just soaring when it comes to electric vehicle adoption.
Speaking of China, XPeng this morning, they are out with a price cut, and they're actually going to extend maintenance services for free as part of the compensation here. But this comes after we just saw Tesla recently lowered their prices too. And so in this key market within China and then more broadly internationally, of course, XPeng has representation, I believe, both in Mountain View, California here in the U.S., but then additionally in China, you think about the market and the adoption that continues to take place within that region. And I think for what the market is pushing back on now, it is pushing back at a price level and looking for not just better deals, but just better financing as some of the infrastructure is continuing to be invested in. I think there is that incentive that many auto manufacturers have to perhaps bring down the pricing now so that they could have a more of a customer lifetime value approach and keeping them within their automotive or vehicle ecosystem as well. Often as you get some of those trade-in, trade-ups, if you're on kind of that leasing structure for some of the electric vehicles too, early in the adoption phases right now.
Something else that we're watching also right now is Silvergate. That's after Silvergate reported earnings today, failing to meet revenue expectations as a crypto-focused bank saw a net loss of $1 billion in the fourth quarter. The company also announced it will be reducing its workforce in order to account for the economic realities facing its business. And this is very important, Brad, because Silvergate held deposits for FTX units and Alameda Research. Of course, we know the implosion that happened there. And so Silvergate was forced to sell securities and related derivatives and really taking a hit there because of this.
Yeah, I'll be honest. I'm trying to figure out the stock move on this one. It's up 21% here pre-market. They recorded a $1 billion net loss attributable to shareholders, which equates to about $33.16 a share. And then additionally, they said flat out, we're expecting a sustained period of lower deposits, and that showed up in their dollar transfers. Dollar transfers were down for the quarter 47% year over year. However, some of the reaction that we're seeing here today, it could be tied to the move higher that we're seeing in crypto over the past 3 weeks, even as you're kind of continuing to look at prices of Bitcoin, and we'll dive into those just a little bit later on in the hour. But Bitcoin has been on the rise, moving from about $16,000 just weeks ago to now what, $21,000 here this morning.
Just about $21,000. Yeah. And we are checking into the opening bell as we're about to start the session today.
Absolutely. And there you've got a live look at the New York Stock Exchange, where the opening bell is taking place on Wall Street. Provident Financial Services, ticker symbol PFS, is ringing the opening bell there. We are off and to the races on this holiday abbreviated trading week. We've got, of course, today's trading session and then 3 more after this one, folks. But as we were taking a look at the futures here this morning, it seems that things are still trying to figure out exactly which way we want to move. But let's take a look at some of the futures, and not just the futures, the U.S. major averages, as it looks like, and as we opened up, mixed at the opening cross, but a little bit of waffling action.
Yeah, exactly. A little bit of waffling. We are seeing a little bit of flatness when it comes to the markets. You're looking at the Dow that's down 0.1%. The Nasdaq also slightly lower. And we're just looking at the sectors because we had seen some of these in pre-market that were under pressure. Financials primarily down 0.2%, followed by communication services. We do have energy that is in the green right now. Consumer discretionary staples is also in the green. Over on the Nasdaq 100, just taking a look at where we're at, we are seeing Tesla up 3.5% right now. We're seeing some pressure on the mega caps, so we're watching Apple and Microsoft, Alphabet that are slightly lower right now, Brad.
All right, that's right. We're also going to check in on another major mover that we're tracking here this morning, keeping an eye on the never-ending story that is Bed Bath & Beyond. Ticker symbol BBBY. It is lower this morning by about 6%. Fears of bankruptcy, they continue to linger here, and as we go day by day, just kind of waiting for more indication of what strategic mechanisms the company will employ as part of its future for the company here. But it just continues to point towards what a bankruptcy and at least the protections that they could get under bankruptcy to try to turn the business around and to get back into some of those strategic initiatives in order just to get back in good standing financially, what that may be. But we heard this from the business update from the company saying we have a clear vision and future for the company at one point in that business update, but then ending it saying that these measures might not be successful and that bankruptcy could be one of the measures that they have to take here in the U.S. as well.
Huge volatility with what we've seen with BBBY. Coming up, we'll head live to Davos for a conversation with the CEO of Anheuser-Busch on the state of the alcohol industry. Stay with us.
Julie, this is a weird event. I'm getting ready for all the cocktail parties. I'm picking out my outfit. And oh yeah, we're all worried about a global recession.
Yeah, I mean, there always is that disconnect at Davos, right? Between the billionaires and millionaires who are here and the critiques of them being sort of out of touch. And that's something we're actually going to talk to people about.
Bring on those espresso martinis, baby. All right, welcome back to Yahoo Finance's coverage of this year's World Economic Forum. Kicking off with our first live guest of the day, Anheuser-Busch InBev CEO Michel Doukeris. Michel, good to see you. Last time I saw you was in our warm studio in New York City. Thanks for joining us.
Thanks for having me.
So this is your first Davos. You have the Davos look down, so that's check done. What have been some of your observations here in the early going of the event?
So I arrived yesterday, and first of all, it's great to be here. No best place to meet people. I was just telling you that I met one of our colleagues from United Nations on the streets, and we had like a 10 minutes conversation walking. Good learnings and great experience so far.
And do you feel like that this is more useful to you as a place to make business connections and other CEOs, or more aligned with the sort of more lofty goals of the WEF to help do things like help fight climate change, for example?
It's a mix of everything because the agendas are super packed and you have the chance to learn. So I like learning experiences, talking to people and watching what they are doing, learning from them. But you always have opportunities to connect with one CEO here, a peer there, and also exchange some ideas around the key topics that we discuss here.
How embedded is ESG and of course, as part of that, sustainability? How embedded is that into the DNA under your leadership at AB InBev?
It's part of everything that we do. We always say that in our company, in our industry, we work with nature and not against nature. And it's so simple to understand because no water, no beer, no crops, no beer.
All sounds terrible.
Right? And because beer is inclusive, natural, but most of all, is very local. So if our communities are not thriving, our business is not doing well.
Has climate change affected at all crops for beer, things that go into beer? Obviously, we have fluctuations in water. We're looking at a Davos that doesn't have as much snow as usual, just as one example. How much has that been affecting your business?
You see that these impacts, in a way, they are always there and intensifying here, intensifying in some places. And we monitor this very closely. We work with the farmers. We have 22,000 farmers that we work very close to them, helping them, supporting them economically, financially, but also with technology so they can understand what is changing and shifting and becoming more productive, more aware, and more business-oriented, not for us, but for their own business to be more sustainable.
I had breakfast with one big cap tech CEO this morning, and I was just struck by his tone. He said, we are in a recession already, not headed to one. We are, in fact, in one. Do you see that with your consumers? Are they trading down? Are they pushing back on price increases?
Yeah, I think that I saw 3 different stories on recession since I arrived, and I'm only 14 hours here. So from deep recession to no recession. What I think is that different places globally are in different stages. And yes, something can happen in all markets, but I don't think that we are too deep into recession so far, right? It depends on the industry. And consumers, you see consumers shifting across the globe, but beer, because you don't have a lot of penetration of private labels, consumers, they change places where they buy more in promotions, they buy different packs, but they don't change their brands of choice.
One of the things that we saw happen in December in the United States, just to speak specifically there, beer prices went up and sales went down, at least for some of your competitors. And we also saw some industry data to support that. What did you all see?
I think that there was a lot of things in play at the end of the year, including the coldest weather that we have seen in many, many years. But definitely there was the impact of 2 price increases overlapping in December. So now in January, you are comping the first price increase of last year. Inflation was very high. It was the first time, I think, in many years that we had 2 price increases in 1 year to catch up with inflation. And we need to see now that's coming Super Bowl season. Mm-hmm. Let's see how things will play in January and February.
So are more price increases coming?
I think that most of the price for the industry, they were done in October, November last year. Now you are comping the year before price increase. So during this period of October, November, December, there were 2 price increases, one done in February and one in October. So there was a load for consumers to digest and retailers. and now you're getting into an easier comp because the last year January price increase is already into the books, and you have only the regular price increase of October.
You mentioned Super Bowl. It is very, very close. Am I going to flip on the TV? Do I see the Budweiser Clydesdales? How are you showing up at this year's big game?
So there is a lot brewing there. The team is going to be releasing some of the TV commercials now, but you can expect Bud Light, Michelob Ultra, and some other of our brands showing up during the Super Bowl.
Do you still get the same bang for your buck marketing on TV as you did a decade ago during the Super Bowl?
It is a combination, so the mix of channels, they change, but Super Bowl is always Super Bowl. Everybody loves the game, we love sports, and our teams, they work creatively to reach consumers in digital, in physical experiences, and also using TV as part of the market mix.
Have you pulled back on your digital marketing at all?
Not really. I think that changing different channels, different ways of connecting with people, but digital has been growing over the years, and I think that continues to grow, but TV remains very important.
One product question is wine so yesterday? Is the best days for wine beyond it? Wine sales have come under pressure, and there's been some talk in the industry that beer is having a resurgence at long last.
So we are not specialists in wine, as you know. We are specialists in beer. And I think that there was some overdevelopment over the wine industry for a while. You see trends going down. A lot of consumers talk about the sugar content and the high calorie. And beer, especially light beers, they're very refreshing. They're very close to people's hearts and occasions. And especially when you have great products like Michelob Ultra, Bud Light, they are always a preferred item for consumers.
Yeah, Michelob Ultra is very close to my heart. Well, enjoy your Davos there, Michel Ducaires, Anheuser-Busch InBev CEO. Good to see you. We'll talk to you soon.
Good seeing you. Thank you.
All right, we'll be right back.
Welcome back to Yahoo Finance Live. Taking a look at the U.S. major averages this morning, we are down across the board flat on the S&P 500. We'll continue to track that. Actually, for more on today's tape, let's get straight on over to Jared Blickery at the Wi-Fi Interactive. Jared,
hey there, good to be back here, and we got a mixed market, but for the most side, we're seeing some downside action. The Dow down nearly 0.5%, the Nasdaq off just a little bit. You can see the S&P 500 trying to flash a little green there. Want to take a look at the sector action for today, and we see energy in the forefront. That's up over 1%. Other big movers, communication services to the downside. That houses Meta, Verizon, Disney, a hodgepodge of various communication companies. Staples in the number 2 spot, followed by utilities and then consumer discretionary. Interesting mix of the consumer up here. Let's just get a quick check of the financials since we got those Goldman Sachs and Morgan Stanley earnings this morning that we've been talking about. Costs getting to Goldman Sachs, but I want to spend a little bit of time focusing on Bitcoin. This is going to be a year-to-date chart of our leaders and sentiment index. Lots of green here. This is very good. This is risk on, and this is what you want to see. Broad participation, especially by some junk, admittedly junk in this rally. But Baito, that is a Bitcoin ETF that I'm using it as a proxy. That is number one. That's up 28%. Let me just skip over to our crypto. Let me see. Here we go. Our crypto heat map here, and just chart the price action in Bitcoin. The fact that it has managed to reclaim the $20,000 price level is huge. This was a stumbling block earlier back in 2019, 2017 actually. That was right before this chart begins. So if Bitcoin is able to hold 20,000, that key technical level, that is a very first step. A first step in a recovery here, but we can see it's been a staggered step of lower lows and lower highs all the way down. So this would be, if it can actually clear about 22,000, that would be a little bit better. But the price action is impressive. I think it's going to be key to watch what happens around the inflation data with Bitcoin, because the Federal Reserve, when we see those big press conferences, guess what? The biggest mover is. It tends to be Bitcoin. So as a leading indicator, what else would you like to watch here, guys?
We have seen that reaction with Bitcoin. Thanks so much, Jared Blickery. Coming up, the future of artificial intelligence. Microsoft is considering taking a larger stake in OpenAI. We'll discuss next. Apple has unveiled two new next-generation chips, the M2 Pro and the M2 Max. It's touting the Max as the world's most powerful and power-efficient chip for a Pro laptop. Yahoo Finance's Dan Howley has more details on this. Dan, talk to us about these chips.
That's right, Inez. This is kind of more of what we're seeing from Apple, where they're trying to bring more and more of their capabilities in-house as far as production goes, design rather. And this is just another example of that, where seeing the M2 Max and the M2 Pro, those are the latest pieces of Apple silicon. They say, as you said, that they offer the best battery life in a Mac. They claim that it's up to 22 hours, which is absolutely wild for a laptop. They also say that, and this is important for people who are doing things like, heavy app use as far as designing apps or video editing, that when you unplug it, it doesn't downgrade the power. So you'll see that in some other Intel-based systems where it'll start to almost reel back in its capabilities because it doesn't want to drain the battery too much. This, they say, you won't see that in the new Mac. So this is really impressive. We have the MacBook Pro as well as the Mac Mini. The MacBook Pro gets both the M2 Pro and the M2 Max chips. The Mac Mini gets the M2 and the M2 Pro. And again, this is just more signs of Apple really kind of developing its capabilities as far as designing chips and then pushing that even further. So you'll remember that they had initially said that the M1, M1 Pro, and M1 Max were really, the top of what Apple had to offer. Now they're pushing that even further. Interestingly, the M2 Max and that statement of it being one of the most powerful chips on the market comes after Intel revealed what it said is the world's fastest mobile chip. So we're seeing this kind of war of words between the two companies as far as their capabilities in silicon goes.
Dan, while we've got you on all things tech, Microsoft is meanwhile in talks to increase its stake in OpenAI. What can you tell us about the significance of this in the two companies?
Yeah, so they already offer OpenAI capabilities as part of its Azure platform, but it was more of on a test case basis. Now there's general availability, which means companies in general can apply to have OpenAI's capabilities built into their Azure platforms that they're subscribing to. So this is a big deal. It shows that Microsoft recognizes that OpenAI is a big investment for them. They want to put $10 billion in it. They originally put $1 billion in, and now they're kind of pushing that further. And it comes at a good time, right? It's also top of mind because everyone's talking about ChatGPT. That's something that has really gotten people's attention with its ability to almost write in a human style. There's clearly been talk about how this could improve Microsoft's position in search through Bing. If they make that really the kind of experience that you get rather than just a number of links that you get with Google, that could push them pretty far beyond. Though, I kind of want to caution that there's, Google is Google, and it will be hard to dethrone it. And they're also working on their own capabilities. But seeing this kind of going out to the broader business public is really a big deal as far as Microsoft goes. Really gives them an edge here, and using kind of the huge amount of discussion that we've had about ChatGPT in recent days is important. They also go out of their way to say that they try to make this as responsible as possible as far as AI goes. So partners that want to use it, or customers that want to use it rather, they need to actually apply and provide the use case that they're going to be using if they get access to it.
Hey, Dan, since you mentioned Google, we're going to go for the hat trick here in some of the mega cap tech companies. Google, we knew they were set to shut down their Stadia cloud offering, but how did they botch this video game experiment?
Yeah, this is something that, they seem to jump into. They had this, these high-flying ideas of integrating YouTube and, people being able to jump in and jump out of games if they wanted to. And, the reality is that it never really came to fruition. They had previously opened up game studios. They shuttered those. They hired some big-name people, and they just didn't make that long-term commitment, it seems. As far as Stadia goes, it never seemingly got off the ground. We didn't have numbers from Google because they keep that pretty close to the chest with things like that. But it seems as though it's just one of multiple projects that Google goes to launch and then either lets languish or falls apart. And that seems to be what happened here. Stadia was supposed to give you the ability to play games on underpowered devices, or any device for that matter, your TV, your smartphone, your tablet, your Chromebook, without needing a high-powered console or computer. But, it worked. It worked well. They just didn't get the kind of groundswell support that, larger names in the business have gotten, being, Microsoft or Sony. Now, Amazon on the flip side, they continue to offer their Luna cloud service. It seems as though they're in it for the long haul. They're going to make this big commitment to gaming. And that's really the only thing you can do. Some analysts I spoke to said this proves you can't just strong arm your way into the gaming market by flashing around a lot of money. You have to be in it for the long haul and really build up that kind of goodwill and attention. And, I guarantee you, a number of gamers, they probably didn't know that Stadia really existed. It was only around for quite a short amount of time. So, it just seems as though Google didn't have, the either will or wherewithal when it comes to getting into the gaming industry like this.
All right, we know you've got the pulse on gamers out there, even got the poster to prove it, Dan, with the Super Nintendo controller. Love it, man. Great to have you here with us this morning. Thanks for breaking this down. Coming up, everyone, we're going to head back to Davos for conversations with Bank of America CEO Brian Moynihan and U.S. Labor Secretary Marty Walsh. Conversations there you won't want to miss it.
We're here at the World Economic Forum in Davos, Switzerland. It is starting to snow, packed house. And Julie, I'm digging your puffy hat. You got the red gloves there. Let's crush it.
I'm ready. As usual, I don't know how you're not wearing a hat at all, but typical size.
Welcome back to Yahoo Finance Live on this Tuesday, January 17th. I'm Brad Smith here in studio with Inez Ferre. Julie Hyman and Brian Sazi are standing by in Davos, Switzerland, doing their best to stay warm out there, but they're serving up some heat with some conversations coming up this hour, so stay tuned for that. We're about 30 minutes into the trading day here, and major averages, they've been trying to make up their mind. The Nasdaq right now is the lone gainer at this point in time, flat just barely to the upside, but you've got some declines for the Dow and the S&P 500. S&P 500 relatively flat, just barely to the downside there. We've got a tale of two banks here this morning. Goldman Sachs reporting its biggest earnings miss in a decade, while Morgan Stanley beat expectations and hit record revenues in their wealth management division. We're going to break down some more of the numbers here. Plus, we've got a big lineup on deck coming from Davos. Julie and Sazi going to speak to Gary Cohn, Brian Moynihan, and Labor Secretary Marty Walsh. That's all coming up this hour. Let's get on over to Yahoo Finance's Inez Ferre, who is at the Wi-Fi Interactive. Inez?
Brad, as you mentioned, a little bit of a mixed picture is what we're seeing. The Dow down about almost 0.5%. Part of that has to do with Goldman, which is down, and also the Travelers Company, which is also down. Those are the laggards on the Dow right now. Over on the sectors, we've been watching communication services, financials that are under pressure, but staples and energy stocks, those are the leaders. And over on the Nasdaq 100, we've got Tesla that's up more than 5%. Also, the semiconductors like NVIDIA are up. A little bit of a mixed picture with the mega caps. I want to note what's happening with the Chinese ADRs because we did get that GDP data out of China. Also, China's population decreasing. So that's just having an impact on Chinese stocks. Also, over on the banks, as you mentioned, a tale of two banks. Morgan Stanley up 6%, while Goldman is up 4%. And finally, just mentioning what's happening with crypto, as Jared was looking at earlier, crypto just above 21,200 per token, guys.
All right. Thanks so much, Inez. We're going to take a closer look here at the big banks. Morgan Stanley and Goldman Sachs, the latest financial players, out with their fourth quarter performances. We've got Yahoo Finance's Alexandra Semenova all over the story here to break down the latest. Alexandra, great to see you. Okay, so what do we take away net from the companies reporting this morning, the big banks?
Well, you guys kept using the word mixed, and that is the perfect word to describe the quarter for Wall Street's six biggest banks. Let's start with Goldman Sachs, the top dog on Wall Street. Goldman's profit down a whopping 69% in the fourth quarter. That drop is, of course, the result of a substantial decline in investment banking and deal-making revenues against the backdrop of a really challenging quarter for capital markets. Goldman's earnings also took a big hit from the nearly $1 billion that the bank set aside in provisions for credit losses. We've seen that, of course, with the other banks as well, setting aside rainy day funds in the event of an economic downturn that sees consumers unable to repay their loans. That's also likely to weigh on the rebound that investors are hoping for in investment banking. Still, though, Goldman Sachs' trading unit had a blowout quarter that helped cushion overall results. Specifically, the fixed income desk fared really well, and equities trading also fared better than its peers. That's clearly not enough to satisfy investors, as we can see based on the stock price this morning. This was also the first time that Goldman reported its results after reorganizing its business into three units. CEO David Solomon has said in the past that the goal of this was to streamline its operations, increase investment management fees, as well as to showcase its strength relative to competitors. Notable with Goldman, too, of course, is its consumer business, which has really been a struggle for the bank. It has not worked out, to say the least. Goldman has lost nearly $2 billion on that business across all of 2022, including the fourth quarter results. And now on to Morgan Stanley, beating Wall Street estimates narrowly. Again, though, Morgan Stanley has seen a sizable drop in investment banking revenue. It did, however, have a record quarter for its trading desk, as well as its wealth management business, which helped offset some of the losses.
And we know we've also been watching layoffs when it comes to the financial sector, because we know that Goldman had recently announced some layoffs. So talk to us a little bit about that. Have we seen any other commentary regarding layoffs?
Well, one interesting thing in Goldman's results was it actually saw an uptick in expenses. It was setting aside more money for compensation, which suggests that it might continue to cut costs, and we might see more layoffs. As we know, the bank laid off more than 3,000 bankers last week. It's really seen the most sizable share of layoffs in the whole industry. Also, Morgan Stanley said that it delivered a fresh round of job cuts in December, slashing 1,600 jobs, or about 2% of its workforce. We spoke about this on the show earlier, but again, one really interesting thing has been the contrast that we've seen between these banks. You know, JP Morgan, Bank of America, not reporting any layoffs, actually growing their headcount, whereas Goldman Sachs seeing, of course, substantial layoffs, Morgan Stanley also laying off workers. So that's going to be something that we'll continue to follow.
Yahoo Finance's own Alexandra Semenova breaking down all things big banks. Thanks so much.
Thanks, guys.
Absolutely. Let's take a deeper dive on the broader markets as earnings season picks up steam. We've got Manulife Investment Management Global Macro Strategist Eric Thurett joining us here on set. Eric, great to have you here with us today.
Thank you.
Absolutely. Okay, so we just ran through some of the earnings, but I think what's noteworthy within the entire situation we find ourselves in right now is that CEOs are signaling this is kind of a time that's unlike any before. However, they're still trying to get ahead of the markets to the best ability possible at this point and signal what's impacting their business. What do you kind of take away from that and what the economic impact could be as well?
Absolutely. I think we're in a period now where we've seen a tremendous amount of tightening from central banks around the world, really trying to moderate the pace of economic growth to bring it back into line with capacity. And so we've obviously got inflationary pressures that we're still dealing with. I think the sign that basically we're still operating above capacity in a hot economy. And so I think the slowdown that we're starting to see is needed, but that does pose a challenge for companies as well. So if they start to see top line revenue declines, what does that mean for their margins if their costs remain elevated?
Also, wanted to point out employment and jobs because we heard Alexander talking about Goldman and the cuts there. We also have seen cuts when it comes to the tech sector. The labor market, though, is still relatively tight. I mean, it's slowing down, but it's still tight. We had a survey out this morning talking about 60% of CEOs surveyed that they are reluctant to lay off workers. So what does this mean for the overall picture? Could we see a slowdown, a recession with a labor market that is still relatively tight? I mean, is this different than other recessions or slowdowns?
Well, I think that's a great question because I think coming out of the crisis or the great financial crisis 10 years ago, we had the concept of a jobless recovery, right? And so in this case, I think the question that you're posing is whether we can have a recession without the loss of employment. And again, as we see in the data, the unemployment rate is low. We continue to add jobs in terms of headline jobs numbers. And what we've seen in terms of reductions are really more high profile, big name reductions rather than kind of sizable quantities. And so I think that's the key piece is the extent to which the overall labor market really is starting to see some challenges. And we're just not seeing it play out in the data just yet.
With some of the warning signs that CEOs are talking about and kind of ripping the Band-Aid off of what those expectations could be and how much it could impact them, what would you be looking at in terms of your investment portfolio thesis right now? And would it be more bullish given that everyone is just kind of putting the bad news out there at this point?
Yeah, I mean, I think, again, as we see the data develop, the high-frequency activity indicators are still hinting towards economic contraction. So PMI is sub 50. Those are economic headwinds that we're still heading into and that are still actually strengthening given the tightening that we've seen from central banks. So as you look to kind of constructing a portfolio, you want to be defensive. So in the defensive sectors, healthcare, staples, utilities, those have seen a tremendous outperformance over the past year or so. The broader markets are still, I think looking at the charts from a technical perspective, still in a downtrend. And so at this point, you still want to be defensive in higher quality on the fixed income side in terms of credit. And again, in terms of sectors and looking more globally, just taking less risk overall.
What about the FX market? Because we have seen the dollar come down a bit. I mean, at one point it was really having an impact on equities. So what do you make of that? And also commodities as well?
Yeah, so I think, one of the key pieces driving the markets, again, has been this central bank tightening. And to the extent to which, the Fed really was at the forefront relative to its developed economy peers in driving that tightening and delivering U.S. dollar strength. So as the Fed gets closer to its kind of end point, we have seen a pretty material decline in the U.S. dollar. And I think as we see, almost the kind of good news or bad news is good news dynamic play out, we could see continued weakness in the U.S. dollar, again, as the Fed starts to look at these growth headwinds and gets a little less concerned about inflation.
Thank you so much, Eric Thurett, Manulife Investment Management Global Macro Strategist. We appreciate it. And coming up, Disney is defending CEO Bob Iger in its board seat battle. Brad will discuss that plus more. Top headlines that you need to know. Stay with us.
Well, let's get down to business. Here are some of the headlines that we're following for you this morning. Disney is defending its CEO, Bob Iger, after an activist investor, Nelson Peltz, and his firm, Triumph, started a proxy battle last week, raising issues about the erosion of Disney's stock price, its 2019 Fox acquisition, and calling out what it says to be poor governance. Disney pushed back on Peltz's bid for a board seat, saying in a filing that its board was where it needed to be to move the company forward, and saying in an investor presentation that Peltz has no track record in large cap media or tech, no solutions to offer for the evolving media landscape. Overseas, though, Didi received global approval. Didi Global received that approval from China's cybersecurity regulator to continue registering new users for its ride-hailing service. The move signals an easing regulatory environment for Beijing's internet giants, suggesting that Didi's app may soon return to mobile app stores following China's 2021 probe into its business. And planes belonging to Delta and American Airlines nearly collided on a John F. Kennedy Airport runway Friday. The Federal Aviation Administration and National Transport Safety Board are now investigating the incident. A representative from Delta said its flight was heading to the Dominican Republic but deplaned after the aircraft stopped on the runway. Delta has promised to work with and assist aviation authorities in reviewing the incident. Meanwhile, American Airlines deferred to the FAA for comment. Inez?
Well, the World Economic Forum's annual conclave is flooding the Swiss Alps with national leaders and global officials. But U.S. President Joe Biden is not in attendance. Yahoo Finance's contributor Kevin Sorelli has the latest. Kevin, talk to us about that. President Biden's not in attendance this year?
You know, it's interesting because in the previous administration, former President Trump also would skip Davos because he didn't want to be seen as too much of a globalist. In this administration, the progressive left has pressured Democrats on climate change issues as well as on Wall Street regulatory reform. So it's become a bit of a political nightmare for the occupant of the Oval Office to decide whether or not to go meet with global leaders, business leaders, and the like. But there are some lawmakers who are attending that call them the political mavericks, so to speak. Senator Joe Manchin, Kyrsten Sinema, as well as Senator Chris Coons from West Virginia, Arizona, and Delaware, respectively, are in attendance. They are meeting with business leaders and the like. And of course, Treasury Secretary Janet Yellen also at Davos, and she's got a big meeting that she's going to be having tomorrow.
Yeah, so tell us more about that meeting. Janet Yellen going to be meeting with China's vice premier on the sidelines in Switzerland. So tell us more about this.
Well, Vice Premier He, this is the first time that Secretary Yellen will be meeting with her Chinese counterpart, and they've got a lot to talk about. Remember, it was back in November when President Biden met with Xi Jinping in Bali. But since that meeting, we've got a host of new economic indicators coming from China. Just over the last couple of days, we know that China's economy grew by 3 percentage points in GDP last year. That beat expectations. I think Reuters analysts had predicted that would be 2.8%, but it's still the second lowest increase on year since 1976, according to the Wall Street Journal. And then lastly, population decline. China's population declining 850,000. This is the first population decrease that they've seen for quite some time. They've still got a population of about 1.4 billion. All of this comes as the conversation here in the United States amongst the C-suite level, whether it's Apple or other companies, is are they going to diversify their geopolitical supply chains? Apple, of course, looking to make more investments in India. So they've got a lot to talk about. China's rhetoric has somewhat softened in the last couple of weeks. I can tell you that I talked to sources on both sides of the aisle here in Washington, D.C., who are rolling their eyes at that rhetoric shift. And of course, in March, we're going to be hearing from Xi Jinping at the annual Parliament Summit. That will be the party summit. That will be the first time that we've heard from him since he's consolidated power just a few months ago.
And Kevin, what's the outlook for the debt ceiling deadline here in the U.S.?
Well, we've got an X date. Treasury Secretary Yellen releasing that letter to Speaker of the House, Kevin McCarthy, on Friday that the U.S. will hit the debt ceiling on this coming Thursday. That means that she's going to have to use what's known as extraordinary measures over the next couple of months in order to make sure that the U.S. pays its bills on time. Speaker McCarthy was on the Sunday shows. He spoke on Fox News Sunday, and he once again previewed that they want to have entitlement cuts. He said to Fox that he is definitely going to be looking at making some type of cuts for entitlement funding, and that he would like to see if there's any way that they can reduce spending. Now, President Biden, for his part, yesterday speaking at an MLK breakfast in Washington, D.C., he called it, quote, fiscally demented, end quote. So get ready for a battle.
A battle indeed. Yahoo Finance's contributor Kevin Sorelli, thanks so much for joining us. And coming up, we'll head back to Davos for a conversation with IBM Vice Chair Gary Cohn. You won't want to miss it.
Fresh off of warning about recessions, Julie, we find the big banks with a very big presence here at the World Economic Forum.
Yeah, exactly. The main street of this town is basically transformed during Davos from all these little storefronts into basically corporate marketing, and that doesn't seem to have changed.
Welcome back to our Yahoo Finance live coverage in Davos of the World Economic Forum. And one of the debates here and really everywhere is whether the U.S. and the global economy is going to enter a recession or not. How much is it going to slow down? Let's talk to someone about that. That is Gary Cohn. He is the vice chair at IBM and, of course, former head of the Council of Economic Advisors for the Trump administration. And so, Gary, what are you seeing? What are you hearing? I mean, you wear a lot of hats, as always. You talk to a lot of people, as always. What's the vibe?
Well, you know the vibe here, because everyone's fairly on the bearish side. Everyone's talking about global recessions. Everyone's talking about recessions. But of course, when I talk to people and ask them about their business, they seem to think their business is okay. So everyone here seems to think the other person has a problem. You know, my personal view on this is, you know, I think we've weathered the storm in the United States. It feels like we're coming out in a fairly decent place. I do think the Fed will probably raise another couple 25 basis points. They're not quite done yet. I don't think they want to walk away. I think they want to put sort of the nail in the coffin on inflation. But all the data shows that inflation's coming down relatively quickly, and we still see pretty positive economic data. We still see employment growth. We still see GDP in a relatively good position. So I'm still cautiously optimistic going into next year. And so I'm clearly in the more bullish camp for those here in Davos.
Were you surprised, Gary, by some of your former peers in the banking industry calling out last week and then also today as well, a mild recession?
I'm not surprised. It's if you're running a big bank and you're running a big business, I think you have to think about that as a possibility. You have to run your business being prepared for the worst. And if we don't go to a mild recession and we don't have that, it's surely a lot easier to run your business having prepared for that than not having prepared for that. So I understand the mentality.
Would this be a Federal Reserve-driven recession?
I'm not going to say it's a Federal Reserve-driven recession. We clearly had inflation. We clearly had a major supply chain disruption coming out of COVID. We could go through the history. During COVID, we became a purely goods economy. The only thing that was driving the economy were things that the United States Postal Service, UPS, or FedEx could deliver to your house. And so we had this massive demand on goods. And so the supply chain broke down. As we reopened the economy, no one had labor, and we changed from our natural goods economy to our natural supply side economy, where we really consume services. So we're an 80% services economy in the United States, but when we went out to start consuming our natural services, no one had workers. So everyone scrambled to get labor back, and it was tough to get labor back in the economy. So we saw quite a bit of wage inflation, and we're still seeing the wage inflation as people are out still trying to enjoy themselves and make up for the lost time that they lost during COVID. You still see, the airlines, you still see the hotels, the restaurants are still thriving and trying to hire people back as we revert back to our more service-driven economy.
So I guess then the question is, if it makes sense CEOs are pessimistic because they have to manage their businesses, they have to have an eye on worst case scenarios. What about the markets though? Because there too, you could argue, especially the bond market is looking for maybe even cuts by the end of the year, which would imply that the economy is going to be doing worse and going to need those cuts. Do they have it wrong?
So I don't know where rates are today. It's when you're in Davos, you get out of
I know. We were talking about how isolated we are.
Total bubble. Well, I guess the U.S. markets are open.
Are they?
So they're open, total bubble. But the 10-year in the U.S. is trading 360-ish. I'll give you an ish. Normally I would know exactly. So, and we've got a front end, Fed fund rate at 4.5, probably going to 4 3/4, 5%. So the Treasury market is discounting what's ultimately going to happen in the economy. And the market is sort of voicing its opinion, I think, relatively strongly. I think the market's right. At the end of the day, as I always say to people, you can trade the market. Billions and trillions of dollars are wagered in the Treasury market every day, and people are expressing their views, and you can express your view, and you'll be right or wrong based on your opinion. The Treasury, the Fed.
By the way, I got a little tip in my ear. It's 3.5% today.
Okay, so
so
by the way,
lower.
So we're down from where we were last week. So think about that. So rates are even lower than they were last week. So the Fed, on the other hand, they can talk. They can raise Fed funds. They can raise the overnight rate. They can control what people get on overnight funding, but that's the only part of the curve they can control. Yes, they can use extraordinary measures, and they can do twists, and they can do QE, and they can do QT, but ultimately, their real opportunity is to control the front end of the curve, and I think the curve's speaking for itself right now to what people are saying about the U.S. economy.
We have this term, and I'm sure you know this, that a stock is dead money if a company is not executing. As someone that has invested in blockchain and even crypto, is Bitcoin dead money here? Do you even touch that? Do you go near it at all?
So I have not invested.
Not invested in crypto.
Not invested in crypto. I want to make that very clear.
But you're a blockchain guy.
I've invested in blockchain. I think blockchain as a tool is a very interesting tool. It's a tool that will modernize the financial services industry. I lived through sort of the revolution of clearing and how we put everything through one of the solutions to the financial crisis was to clear everything. So we went from clearing the most liquid items in the world to clearing everything. I think blockchain is a further evolution revolution on the clearinghouse, and it's being able to real-time clear things and move title instantaneously and move cash instantaneously. So I'm bullish on blockchain. On crypto, I really don't have a view on crypto.
So do we sort of need to, like reputationally, do we need to divorce blockchain from crypto?
100%.
Because it's a technology, right? And it can be used in so many other things.
I mean, look at me, I just lumped it right in together.
Yeah,
so,
no.
But so how do you do that as an investor in it, as someone who wants it to go further? How do you get it to people to sort of separate the two?
Think of blockchain as the clearinghouse. We don't talk about the clearinghouse. You don't even know who clears the house, who the clearinghouse is, and you don't even know about DTCC. You don't know where the securities are settled. We don't talk about the settlement agencies.
You don't need to. Most people don't need to.
You don't need to. You talk about the individual securities. Bitcoin is the security. It is actually a security, and there's many other securities. People have created other cryptocurrencies. You can talk about them, but the blockchain is actually the underlying infrastructure that allows these securities to be transacted and to be settled in real time.
Gary, you came in an interesting time for IBM. A lot of transformation at the company. New CEO Arvind Krishna. Investors still seem doubtful on a turnaround. Where is IBM on that turnaround plan?
Look, I think Arvind has laid out a very distinct plan on revenue growth, on free cash flow growth, and he continues to execute upon his plan.
And kind of what are you doing there, for lack of a better question? You know, like what do you see as your role there, and how do you help with the strategy that he's laid out?
Look, I came in a couple years ago when Arvind came in as the new chairman and CEO. He asked me to come in and help him think about his strategy, think about his senior management team, think about what IBM of the future should look like, help them with clients, help them with client relationships. And it's been a really interesting experience to learn about the technology world and the evolution. IBM is still on the forefront of cutting edge technology, which is extraordinary. It's a whole new world for me to learn. It's been a really interesting and fascinating couple of years.
Great. Gary Cohn, thank you so much for being here. Vice Chair at IBM, the aforementioned.
Thank you for having me.
Thanks a lot. Appreciate it. And we will be back with more, of course, but for right now, keep it tuned right here on Yahoo Finance.
a very sympathetic man.
Mm-hmm.
So our team, Candace Browning Platt and our research team, have moved their recession look out a little later in this year into early next year. That means that they actually have a positive number for GDP growth in the U.S. this year, slightly positive. And it'll be a mild recession, largely because the stimulus and other things, even though the Fed's raised rates, you see the capacity of the American consumer to keep going. And so they're basically mild recession early next year. But over the last year, that's been constantly pushed out, and so we'll see what happens. But mild recession, slightly down for a couple of quarters, and then back to slightly up, and then more normal in 24 and into 25.
How much pressure is the U.S. consumer under right now?
Well, it's an interesting thing because it's a sort of a tale of two cities. On the one hand, our customers spend $4 trillion a year. That spending dollar volume grew in the fourth quarter of 22 by about 5%. In the first quarter 22 over first quarter 21, it grew 14%. So you can see the impact of them slowing down. Now, it's up dramatically from 19, like 25, 30% in the aggregate, or even more. So if you think about that, they're spending well. The first part of this January, the first 10 days or so, they're up about 6 or 7%. So a little bit fell over because of delays in travel. So they're spending nicely. The money in their accounts continues to be solid. It's coming down slightly. They're spending down some of the excess stimulus and excess savings, but they're all employed. I mean, the thing people forget is the United States employment picture is still pretty strong, and the Fed needs that to get a little worse to have that services side inflation come back in line.
Within the context of this mild recession call by your team, what happens to unemployment? Where do you see that unemployment rate go?
So there are 3 or 4 core components. Unemployment gets to 5%, a little bit 5% plus as we move into the latter part of this year into next year, and sort of stays there and comes down beginning the end of 24. Without unemployment, I always ask our economists, how can you have an unemployment-less recession? How can you actually have 2/3 of the American economy driven by consumers if they're working, getting paid, and wages continue to rise? How can we have a recession? And they can give me a lot of explanations, but the reality is, the manufacturing side is slowing down. Some of the consumer activity is slowing down, but unless we see unemployment move up, I think it's hard to square that with a recession, and that's what's going on. So our unemployment is to move up to 5%, or else they really wouldn't be able to predict a recession.
Would this be a mild recession within lower income consumers? I look at a lot of things that consumers are feeling right now on the lower end. Inflation, it's come down, it's slowed, but it's still very high. Average, those higher end consumers appear to still be out there spending aggressively.
Look, the problem with inflation, why you got to cut it off, it hits the people who can least afford it, because food prices mean the same. People don't eat a lot more. So what happens is, think about the percentage spent on that. Gas prices, same thing. So that's the thing that people have to be careful about. And when people say, well, if they fight inflation, rates go up, somebody can't buy a new car that's an affluent, that's not really what they're after. They have to make sure that inflation comes down. So the core wage growth of the American median income household will exceed the expense growth, and therefore they can cash flow positive. And if you look across multiple years, they're still okay, but in the more recent times, real wage growth has fallen back, and that's caused some of that slowdown by the consumer.
And speaking of slowdown, the Fed and their interest rate hikes have also really impacted the housing market in this country, really slowed down that market. How long do you see this downturn playing out?
Well, the reality is, you're going along after the financial crisis in the recovery, a sort of a normal long-term growth rate. Then you spiked up in the pandemic because there was this demand created, low interest rates, plus people doing different kinds of housing thought processes, and that's coming down. And so the Fed raises rates to get to the things that are rate sensitive: housing, cars, corporate debt borrowing. That's what they need to do to slow down the economy. That is their job, to get inflation under control. And so we'll see it tip down, but frankly, it's not the issue, because it's not overlent and overborrowed as it was before the financial crisis. Just the structure. Our LTV in our mortgage portfolio, which is $200 billion, is in the mid-50s or something like that. So even refreshed. So it's not, the banking system's in good shape, and so it's just different this time than that time. On the other hand, they have to slow down the housing appreciation, because that wealth effect lends people to start borrowing that money and doing things, and they've done that.
I'll call you this. You're I would say, the wartime CEO of 2010 at Bank of America. Those times they were absolutely terrifying. The home market slowed, stock market slowed. Is what the Fed is now doing with rates, unwinding that liquidity, are they sowing the seeds for something like that again?
I don't think so, because the transparency of the Fed, going back to Jackson Hole and Chairman Bernanke saying, we're going to tell you what we're going to do, and the dot plots and all this stuff. They're signaling the market. Sometimes the market takes them on saying, you're not going to raise rates as much as we have rates going up, 5.25. The market sort of say maybe not, those types of things. But I think the transparency, I think the care, I think the amount of data, honestly, people forget how much data is there. And they're getting it real time, and so they have a better sense. But it's tough to get the services side inflation down, and that's what they're focused on. So if people are looking for indicators, they're looking for new claims for unemployment, still very low, as low as they were in history almost now. And job creation still slowing down, but still pretty strong. So I think those are the indicators looking at. But the real-time nature of this, I think, allows them to see a little bit further the impact of their activities. And then we're all feeding them data about the market's activity and stuff that wasn't transparent before, where the peas are under the mattress, so to speak, in terms of risk. When something goes down instantaneously, we could all tell them what the exposure is to one of these named things that has a problem. So I think it's just different. Now, is it perfect? We'll find out, but I think they do a pretty good job. We do a pretty good job managing these companies. My peers and colleagues around the world take it very seriously to maintain the stability and the capability of the bank institutions, and the regulators and central banks have taken the same approach.
Equity markets have stabilized a bit to kick off this year, and in large part because of this expectation, I think, of we get rate cuts at some point this year. Do you think that happens at some point in the back half of the year?
Our equity market strategist, Savita Subramaniam, has basically the equity market flat for the year. Now, within that, she's saying there's great opportunities in different sectors, but in part, she said that last week, and then she sort of was confronted with the market actually moved up to match her year-end thing. So she sort of said, you have to think about this. And so that's not an exact 4,000 number, but it's a number that gives you an indication that the feeling is, as a recessionary environment's there, as corporate debt gets more expensive, as the labor market softens, the idea of earnings growth for companies, that's one of the challenges. And so I think that's all going to wash through the system. But does the Fed need to lower rates this year? We're still thinking, and I think people have to listen to them, they may leave this higher for longer just to make sure they squeeze out that services side inflation, and just as a slower burn on that.
The theme here at the World Economic Forum is a cooperation in a fragmented world. Now, you met with the administration, you were in that room with a lot of your fellow CEOs. How fragmented is the world from a business perspective?
Well, I think there's the challenges with the administration yesterday, bipartisan here to engage with the business community. By the way, leaders around the world here to engage with the business community. That's the unique thing what Davos has is, you can walk down the street and see, people from administrations around the world. You can see business people from around the world. You can see advocates of all different types around the world. So that's the value. And so I think the issue is trade, and the issue is the free trade and the globalization, the supply chain globalization, things that provide a great benefit to the world's citizens. Called into question, but it's a little bit more about resiliency supply chain than people think. And so people have learned a lesson about single source supply at the lowest possible cost. Maybe it needs to be multiple source. That's going on in the business community. But what they want to know is what are the set of rules that they can actually develop those multiple sets and drive it. And we got to make this just transition for energy. We got to do a lot of things in the world to solve a lot of problems. And the best way to do it is with the cooperative agencies. And so whether it's the WTO, whether it's the IMF, whether it's the World Bank, whether these multilateral and in governments themselves, G7, G20, the idea of coming together and saying, we got to solve these problems. We can have differences. We can be strategic competitors, but we have to have things that we're trying to solve, and that's what you hope comes out of sessions like this.
And that was Bank of America CEO Brian Moynihan looking for a mild recession at some point this year. Now, coming up, you see him live remote from the White House on Jobs Day on Yahoo Finance, but we have him in the flesh here at the World Economic Forum in Davos, Switzerland. That, of course, is Labor Secretary Marty Walsh. We'll be right back with Marty Walsh next.
Welcome back to Yahoo Finance's live coverage of the World Economic Forum in Davos, Switzerland. Saz and I are pretty excited about this next one, and that's because we have never met this next guest in person, but we talk to him every single month. I'm talking about Labor Secretary Marty Walsh, who is here with us in the flesh here in Davos. It's so good to see you here in person.
Good
so good to meet you in person.
Very scenic, very nice.
It looks nice, you know, it's beautiful background here.
Yeah, and this is your first time in Davos. So talk to us about what you're trying to accomplish here and why you're here.
You know, anytime you get a chance to come to something like this is a little different, the World Economic Forum, but it's about sharing best practices, it's about networking, marketing, all that stuff that you do. And as a federal government, you know, the conversations have been a lot of different conversations here, from workforce development to job training to skilling up. I've had a chance to talk to the minister from India, the minister from Italy, companies, things like that.
And are you finding that the challenges that they're having are similar to the challenges we have in the United States?
Yeah, a lot of them are similar, a lot of them are a little different. You know, when you talk about inflation, obviously in the European countries, it's in double digits, it's higher, and they're asking, what do you do in the United States to bring the inflation down? We're talking about, you know, in India, they're talking about education and looking and reimagining K-12 education and you know, I'll bring that back to Secretary Cardona. And so it's really a lot of those conversations and talking to a lot of companies about, you know, companies that are working in the United States, what they need, and asking them what can we do better as a government? What can we do better as the Labor Department, Commerce Department, and working with my colleagues in the cabinet?
What are they telling you? Sorry.
No, they really, you know, I think a lot of them are very happy they're happy with the relationship between Commerce and Labor, and they've never seen that before. And myself and Secretary Raimondo and our teams work closely together. And they're saying this is very different of a feel in government. It's usually Commerce over here, Labor over there, and having the two of us together working, thinking about the future of work and getting people skilled up is really important.
You're constantly traveling around, visiting businesses, in large part, still creating jobs. Tesla, you name a lot of manufacturers creating jobs in this country. The vibe here is that we are near a recession, or some executives I've talked to, we are in a recession. Are you surprised by that tone?
Until you talk to, as we said off camera, until you talk to them one-on-one, and they're all like, oh, my business is great. I did have a meeting with one big corporation in this country, in America, today, and I asked him the question. I said, well, what do you feel? He said he didn't feel that we're headed towards a recession. He thinks that just this economy is very, you know, there's a lot of buzz around it because of the stock market, because of labor participation, because of inflation, and they said there's a lot of buzz, but he thinks that we're still going to continue into a strong 2023. This is from a business, not from,
right.
You know.
One of the things that we've talked to you consistently about is immigration in the U.S. and the importance of getting foreign workers into the United States. Have you been having conversations about that with some of the foreign leaders, for example, who are here, and what's their view on what should be maybe the free flow of labor across borders?
It came up today in a conversation, and you know, when you think about immigration and you think about other countries, in a lot of ways, the United States, we're at a disadvantage because other countries have ways to get import immigrant workers into their countries for big tech jobs for working in restaurants, and we don't have that pathway, at least a big enough of that pathway. And I think that, and I've said this on your show before, I think one of the biggest threats to our economy is not inflation, or wage growth. It's lack of workers, and immigration reform is a key to that. And hopefully, the Congress, the Senate, and the House can figure that out and do something on this bill.
Have you been dismayed a bit by these big layoff announcements from big cap tech companies? They're huge, and these are sizable layoff announcements. Amazon, you name it here.
Yeah, I certainly you don't want to see layoffs, and what I'm monitoring there is to see if these are short-term or long-term and what's going to happen there. A lot of the folks that get laid off, they're going to find jobs. I mean, one thing I've talked to companies too, they're actually, I wouldn't say they're excited, but they're pleased that these giants are laying people off, because a lot of the other companies are looking for tech support and they can't get them because they've just taken every single tech worker to work in these big companies. So companies are going to...
So you think it's short term?
I'm waiting to see. I'm watching it, monitoring it, obviously. You want to make sure that all industries are moving forward. And that's also, I think, for me, a sign. You look at recession, you say, okay, what sectors are slowing down? If we had to slow down in 10 different sectors in the United States of America, then I'd have some concern.
Just to circle back a little bit to immigration for a second, because it's not just foreign leaders who are here. You come all the way here from Washington to get away from Congress, and some of the members of Congress are here too.
Last night.
And I think some of them are the folks who were involved in some of the immigration negotiations, and I just wonder how often you're talking to them on that front and whether there's any movement.
Well, I think, certainly there's some of the senators that are here that have been working on the issue moving forward. The House passed the bill last year, immigration bill that passed the House that didn't pass the Senate. I think that as long as we can get a bipartisan group of folks together, I think that that's going to be key moving forward when it comes to immigration. I think a lot of people think of business people that are watching this show right now are thinking immigration to fill jobs that are needed that men not have workers for. The average American is thinking immigration. They see a picture of the southern border, and I think they're two very issues. We have work to do. There's no question about it on the southern border. The president was there the other day and did a walkthrough and tour of the southern border to see how do we fix that issue. And that issue was in Trump's administration. It was in the Obama administration. It was in the Bush administration as far back as we can remember. But I think we have to separate the issues, deal with the southern border, but really think about our economy and immigration, and how do we pass a bill where people that come to the United States of America get educated, when they graduate, if they don't get a visa, they don't get thrown out, but they have to go back home. We're losing that. I mean, you think about the ability for us to keep some of that brain power, if you will, in the United States working in the country. It's important. I come from Boston. I'm the mayor of Boston. We have 28 college universities inside the city of Boston. Many tech companies in Boston would love to be able to hire, if they can't hire enough students, to get some of the foreign students to come and work for those companies. And that's important for our ecosystem. And people might say, well, we don't need them. No, we do. We have more jobs than people. So we need the people.
Mr. Secretary, it sounds like you still have a lot of work left to be done in this administration. Do you want to serve in the administration, assuming that President Biden runs again and he is reelected?
That's up to President Biden. Okay. That's up to President Biden. But there is a lot of work to do. And when I'm done here tomorrow, I'm going to Austria, and I'm going to be touring some companies about their apprenticeship programs and really thinking about how those programs work and creating pathways. So we still have a lot of work to do in this administration.
You're not going anywhere.
We're not going too far ahead. We're not looking too far ahead right now.
Okay.
We're taking this a day at a time. Okay.
Marty Walsh, again, great to see you in person. Great to talk to you in person.
No Dunkin' Donuts here. I apologize.
Yeah, there's no Dunkin' Donuts. It's all right. The coffee here is pretty good.
Coffee is pretty good. I'm not complaining about the lack of Dunkin' Donuts. No, exactly. Labor Secretary Marty Walsh, thanks so much.
Thank you.
Appreciate it. And that does it for Brian and us, at least for now. We'll be back again. Keep it right here on Yahoo Finance.
I need my Dunkin'.
No, you don't.
Welcome back, everyone. It is time for Cut for Time. 3 stories, 1 minute each. We start with this. TikTok is trending down a new path, transparency, as the popular social media platform enters another year of negotiations with U.S. regulators to stay in the country. It is reportedly putting together a $1.5 billion reorganization of its U.S. operations. This is according to the Wall Street Journal. So the regulatory body that they have been negotiating with now for years has been CFIUS. And what is at stake here is that they already in the background are going up against a Congress here in the U.S. that's already looking at bills that would possibly ban TikTok from operating. And so really as part of this plan, $1.5 billion, kind of revamp the operations and see what kind of data transparency there might be that quells the concerns of some Congress makers and even users of the app.
That's right. And those Congress makers being on both sides of the aisle. And this has to do with data, concerns about data, and whether the Chinese government could take that data somehow and to have power over that data. So really important for TikTok as far as this sort of initiative is concerned, and that transparency for them. United Airlines is taking flight in its newly renovated training center in Texas. The $32 million expansion more than doubled the facility size and including more training space to support its growth plans. And United Airlines, big ambitions for its growth plans and planning to hire some 15,000 people 2023, 4,000 of them being flight attendants. What's interesting is sort of the layout of this training center. It has mock seats, a 400-seat auditorium, and even a practice pool for evacuations, for safe evacuations in case of a landing on water.
Yeah, United got a really big team, got some really big dreams here, but it's really going to need to get bigger as it really kind of comes at a time where we know that there's been this pilot shortage. United, among other airlines, has been trying to ramp back up its capacity to get to pre-pandemic levels. And so with that ramping up in capacity and hoping to quell some of the shortages on the pilot and staffing side, even as there have been more negotiations with pilots across the industry for United to remain competitive, it's going to come down to what those training facilities really look like and making sure the pilots and flight attendants want to fly with United as well. Also here, from the airways to the highways here, Uber drivers in Europe at least can now rent Tesla and Polestar cars through Hertz. Drivers in London, they will get first dibs on the cars, with Paris and Amsterdam soon to follow here. This has been awaited for, I want to say about 18 months now, as we've really heard some of the ambitions from Hertz to integrate more of the electric vehicles into their fleet and allow people to rent them out. So it seems like it's going to be about 25,000 Tesla vehicles, and that's going to be coming by 2025 through this partnership with Hertz as well.
Yeah, and Uber already had a partnership with Hertz for a discount for drivers to be able to rent cars and drive those vehicles. But now this will sort of deepen that relationship as well. And Europe is in an aggressive timeline to get rid of fossil fuel cars. So this also is an initiative that sort of takes them towards that timeline as well. But really interesting. I've actually ridden in an Uber car that was a Tesla here in New York. Yeah, and it was great to, I'm getting a Tesla. Couldn't believe that I was actually getting a Tesla as an Uber car.
That's awesome. Yeah, surprise to the upside. That's what that is, guys. Coming up, Julian Saw is going to continue our coverage from the World Economic Forum in Davos, including a conversation with none other than Will.i.am. You do not want to miss it.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo, and here's a look at what I'm watching today. No Midas touch for Goldman Sachs, the investment banking giant, the latest victim of a deal-making slowdown. Markets slip as investors reassess the landscape, will ask if repositioning is on the cards. And caught in controversy, from a company he took private to one he didn't, it seems Elon Musk can't avoid the courtroom. We look at the fallout from his infamous funding secured tweet over Tesla. And facing a blizzard, almost 1 year to the day since Microsoft announced its biggest ever deal, reports of new roadblocks emerge. Is it ever going to close in its current form? We'll discuss this hour. But first, let's take a look at the major indices, see how they're faring 90 minutes into the trading day. A mixed picture at the moment, but just barely. We see the Dow there down almost 1%, about 300 points there, as they're digesting the start to the market's earnings season so far, especially with the biggest banks reporting and warning of recession ahead. That's really weighing on the Dow. S&P there off about 4 points. Nasdaq relatively flat there, just slightly in the negative. All right, let's also take a look at what we're seeing with the Treasury markets as well. We know that more data signals that the worst of inflation has peaked, so we're seeing some of these shorter-term yields, the 5 and the 10, declining slightly there. We see the 5-year down 0.86%, the 10-year down about 1/3%, the 30-year just slightly in the positive there, about 0.06%. Well, as we've been discussing, earnings season is ramping up, though the road ahead for investors is looking a bit dim as the S&P 500 is expected to report a year-over-year decline in earnings. That's according to a recent FactSet report. Well, here to shed some light at the start of this earnings season is Yahoo Finance's Jared Blickery. Jared, how's it looking?
Well, let's start with the good news here. This is Q4 earnings at a glance as of last Friday. We had some more earnings this morning, Morgan Stanley, Goldman Sachs, but we're still early in the game here. And so some two key stats. For earnings reported, 79% have had profits better than expected. That's in terms of EPS, earnings per share. 7.7%, that is the amount by which earnings are exceeding those estimates. But as you alluded to, Rochelle, we're looking at a drop in year-over-year estimates in EPS. That would be profits of 3.9%. When you get multiple quarters, at least 2 quarters of negative earnings growth or earnings decline, that is a technical profits recession. And that's in line with the technical definition of a recession in the general economy, where you have GDP going negative 2 quarters in a row, even though that's not the official definition of a recession. But for profits, this is something that's key to watch. Now, let me show you another chart. This is S&P 500 earnings growth. This shows this last quarter, the current fourth quarter of 2022, that is expected to be negative. That's that little drop below the white line right there. And you can see how that compares to this huge drop that we had around the pandemic. So nothing approaching that just yet. And you take a look at the reaction after that. This was the result of the huge fiscal and monetary stimulus that we had that really goosed those profits, those corporate profits. So what are we looking at right now? We have a couple different ways of looking at this. Mike Wilson over at Morgan Stanley, who has been the most bearish and was really spot on in 2022. He's been calling he's had some major earnings call for this year. He's looking for operating margin to contract. And this is all based on the fact that goods inflation, that is CPI in the goods sector, that is falling, but wages are sticky. So as long as companies have to pay workers more and they're also able to charge less for the profits, that could theoretically continue to weigh on profits. So where we are right now, we're more in line with a 2015-2016 earnings recession, where we saw the S&P 500 just barely enter a bear market, down about 20%. We were already in a bear market before the Federal Reserve started tightening the screws last time. So this is quite a different situation. I think what we're looking at here is things are either going to stay. We've already reached about the bottom that we're going to get, and the upside, the pain trade is to the upside, or we have a lot more downward revisions to go, and we are only at the beginning. So I don't know how much insight that provides you, but either things are about to get a lot better or they're about to get a lot worse.
Certainly keeping in mind, and we'll be hearing from the Fed at the end of the month as well, adding another wrinkle into things as well. Jared Blickery, thanks so much. All right, well, bank earnings still providing a bit of a mixed picture as Goldman Sachs suffers a shortfall in its profit while Morgan Stanley pops on an earnings beat. Here to discuss the mixed environment for banking amid heightened macro uncertainty is Devin Ryan, JMP Securities Director of Financial Technology Research. Good to see you, Devin. So as we're seeing here, some mixed results. In your notes, you're saying not necessarily surprising, but what about Goldman Sachs? What should we read into that?
Good morning, Rochelle. Great to see you. Thanks for having me on again. I think for Goldman, there's a few things. And it's actually a little bit less revenue centric. It's more, the compensation ratio is a little bit disappointing, particularly because they're still going to have to absorb those headcount reductions in 2023. I think that was a little disappointing to the market. Credit costs were a little bit higher than I think people were expecting. And then, the stock's also had a really nice move here. It's up, roughly 25%. From last quarter's earnings print. So, arguably got a little bit ahead of itself. And so that's why, heading into earnings season, we were a little bit more neutral on, the large cap investment banks, just given the moves we've seen. But, really for Goldman, I think we're going to put this quarter behind us pretty quickly, and the attention all turns to 2023, where it's going to be a tough start to the year in our opinion, but we're actually probably more constructive than consensus as we look into the back half of the year.
So, in fact, you have a price target on Goldman Sachs of $470. What is going to get it there?
Yeah, so as I said, I think the near term, it maybe even got a little bit ahead of itself, and that was our view of why we were neutral into earnings. What needs to change is the capital markets backdrop. They're the most capital market centric of the large banks, and 2022 was an aberrationally challenging year. And I think the question is 2023 going to be better? And covering capital markets for 20 years or so, the one thing that we know is that uncertainty and big change in markets is never good. And so our view is that even if, the 2023 economic view is a little bit softer than 2022, which I think, a lot of banks are coalescing around right now, I think we're gonna have more certainty around that. And that'll actually be a better environment for things like investment banking, M&A. And so that's the environment where Goldman Sachs stock is going to do better. And then on top of that, I think they're going to give a lot more detail at their investor day in late February, and maybe even the stock starts to move positively into that, because I think that they're very focused on operating margins, they're very focused on their return on equity targets, and I think they're going to pull a lot of levers to try to improve their financial position. So those are a few things. Again, just kind of some near-term versus long-term dynamics today.
And as we look at some of the stronger performance here, JP Morgan beating consensus on fourth quarter earnings there. What is your take on what JP Morgan is perhaps doing right, or how it's managing the situation versus, say, a Goldman Sachs or the others?
Yeah, I think a little bit of it's just business mix. So, JP Morgan, not to take anything away, because they're really hitting on many cylinders across their business and taking market share, as is Goldman Sachs. But, there's been huge tailwinds for banks that are net interest income driven, which JP Morgan obviously is benefiting from higher rates and some loan growth. They're still executing on their plan. I think they're preparing for a mild recession. I would say if we get a mild recession, financial stocks actually do, I think, relatively well. The thing that we have to avoid is a deep and prolonged recession. Heading into this year, I think there's a lot of concern around a hard landing and a deep recession. As we're getting data that's maybe suggesting that it may be a little bit softer than that, that's why these stocks have started to perform better. And I actually think that we can see another leg into the back half after, what's still going to be, in our opinion, a pretty choppy quarter or two here. Just, the first, second quarter probably going to look pretty similar to how we ended last year, which was, obviously a tough end for particularly capital markets.
And Devin, we saw from Jamie Dimon, he raised the risk of a mild recession. We saw Bank of America, Wells Fargo echoing those sentiments as well. When you look at some of these large lenders who are bracing for a recession, worried that perhaps some of these borrowers are going to start defaulting on those loans, who do you think is the best prepared at this point? Are enough banks prepared for what might happen?
Yeah, so I think the large banks are preparing, and they tend to be a little bit conservative and want to get ahead of issues. So the fact they're talking about a mild recession, I think, is actually good, because if things were really turning over, they'd probably be getting even more conservative than that. I think the areas that are softening the most are kind of obvious. Housing and banks, associated with that are, I think, going to be challenged. And banks kind of attached to the lower end consumer. Inflation, even as it's rolling over here, is still creating some headwinds for kind of the lower end of the consumer spectrum. And so, folks with exposures to those types of loans, the good news is most of the big banks that we look at in the investment banks, very diversified. And actually, if you look over the past year, yes, some businesses that are tied to higher rates were doing well. As we talked about, capital markets and some other areas like asset and wealth management, with equity markets down 20%, we're seeing big headwinds. And so we actually expect more of a mean reversion in those areas, which will offset even some slowdown in a couple of those buckets that I just mentioned. So that's why having diversification and having scale, I think, is really important as we look out over the next year.
So, Devin, what are you going to be looking for in terms of the commentary that's coming out from these earnings reports?
Yeah, so I think what we're hearing and what we're paying attention to is credit. That's telling us about kind of the economic view. And thus far, credit's really hung in, I think, better than we probably would have expected 6 months ago, just given what's happening in the markets. I think we need to continue to hear that type of commentary moving forward, and there's still a lot of uncertainty. And so thus far, I think the credit commentary, obviously big banks with large deposit bases, what are customers doing with that excess cash? Are they moving it to alternatives? Are they having to spend that and pay their bills? And so I think watching kind of the deposit evolution is another area. I would say thus far earnings season's been pretty much as expected, and I think that's a good thing. Again, the big question from here is the magnitude of the slowdown. Clearly, the economy is going to slow with much tighter financial conditions. The magnitude, if we can avoid a deep recession, I think financials, these banks actually do very well. But that's the type of commentary we're looking for. How much is this slowing economy affecting their businesses?
We'll certainly be keeping an eye on that as well. A big thank you there to Devin Ryan there, JMP Securities Director of Financial Technology Research, for joining me this morning. Thank you. All right, shares of Alibaba trading lower this morning as activist investor Ryan Cohen reportedly built a multi-million-dollar stake in the Chinese tech giant. That's according to the Wall Street Journal. Now, as part of his investment, Cohen seeks changes within the group and looks to push Alibaba to boost its share repurchase program. Now, this comes after Cohen first contacted Alibaba's board last year to express his view that the e-commerce company can achieve double-digit sales and nearly 20% free cash flow growth over the next 5 years. All right, coming up, facing the fire. It turns out the funding wasn't secured. It's been over 4 years since Elon Musk's infamous tweet suggesting Tesla was going private. Now he's going to court. We'll look ahead to a big civil trial next.
This is Yahoo Finance Live. Once again, you are back in Davos, Switzerland at the World Economic Forum, and Brian and I's coverage as we are getting snowed upon more and more. And we're joined now by a man who this is his 8th World Economic Forum. That is musician, investor, nonprofit, what would you call yourself? Foundation. Will.i.am is with us.
Yes, in the house.
A lot of hats. So, you, as I said, you've been here 8 times. What is your goal for this particular Davos?
Well, this is the first time since COVID that we've been here in the winter. I was here in the summer, which was an odd Davos. But every single year that I come here with the sole premise to get as many skill sets or programs for my kids in the school, my foundation work. So I've had my program since 2008. I started with 65 kids. Now we serve about 12,000 students in Los Angeles with computer science, robotic skill sets. And so I come up here to find mentors. We've had great mentors from Boeing, NASA in the past years, and we've sent kids to Dartmouth and Brown and Stanford. And I want to continue to scale and grow our the work that we do there, given how technological the world is going with robotics, AI, generative AI, natural language understanding, conversational computing, and just anticipating the inevitable, where these new technologies will render a lot of jobs obsolete, but there's going to be new jobs that are going to be unearthed, and they should come from communities like mine.
You encouraged me to improv before we came to the segment, so I'm just going to roll with it. What do you, as someone that has written songs and music that is the fabric of our lives, what do you think about AI and something like a ChatGPT?
I think ChatGPT is awesome. I think it's going to be a great co-pilot for creatives. And hopefully it raises the bar on everyone's creativity. Now you have something else that's that responsive. You could push it and it will push you. I think it's awesome. It's like asking a mathematician, hey, what do you think about this thing called the calculator? You know what I'm saying?
It's pretty awesome.
Yeah, it's good. It's pretty cool.
Yeah, I mean,
I like calculators.
Well, ChatGPT has probably some implications for our business too, but that's you're not interviewing us. So, but it's interesting to talk to you about technology because you have partnered with technology companies in the past. What are you most excited about on the edge of technology right now?
I'm excited about the youth getting their hands on these new tools because they are our tools. And folks that are nervous and worried are conditioned by yesterday. And there's a lot of folks that have been left behind due to humanity and the inhumane practices or lack of investment. And now these kids, these folks from these communities have the ability to solve the problems themselves, create industries themselves. And so the jobs of tomorrow are going to be amazing when they come from, kids that look like me that are from communities like the ones that I came from. And it's awesome. 2030 is going to be awesome. Let's go.
And those kids that you're working with through your foundation, we've heard a lot of pessimism here, right? So bring us a little hope. What are you seeing in these kids? What are you seeing in terms of their potential? Because there's a lot of talk about mental health problems among younger communities. There's a lot of talk about access to technology. There's a lot of talk about them using technology too much, particularly when it comes to social media. But what are you seeing when you meet these kids?
Okay, imagine it's 1923. And there were kids like me from some inner city, free slaves, sons of freed slaves, daughters of free slaves. And a lot of us were not a part of the third industrial revolution. When it came to electrifying America and the world, connecting, we built the railroads, but we didn't own the machines that were on top of the railroads. We weren't the champions of the industry. Thomas Edison did an awesome job creating the gramophone, and we sung songs that were recorded on them. But it took Barry Gordy and the to really show us that we can be the entrepreneurs in the record industry as well. And now here we are in 2023, and let's go. We're a part of that conversation. We're being, we're embodying what it means to be engulfed in these skill sets and applying ourselves. I'm seeing our kids do that. It's a brand new world, and let's go. Let's bring it.
Before we let you go, Will, you mentioned mentors earlier in the segment. Who do you go to for advice when you want to put money to work, when you want to, think about or sound out some ideas you may want to put to work with your foundation?
Mark Benioff, that's my big brother, mentor. I love Mark. Thank you for all the things you've done in helping us at I Am Angel. Ron Conway, that's my bigger brother. MC Hammer, that's the dude that connected me to Ron Conway. Jimmy Iovine, that's the guy that really saw the spark in me. So yeah, there's my go-tos, as well as Oprah Winfrey. I love her. That's where I went to start my foundation. I started on the Oprah Winfrey show, and she pushes me to bring the best out of myself. Gayle King, I love her like an aunt. And so yeah, I'm blessed to have an awesome network of folks to keep me on the straight and narrow, and pushing to solve problems.
Well, thank you so much for talking to us. Appreciate it. Will.i.am, musician, investor, philanthropist was the other word I was looking for earlier. That escaped me. Thank you so much. Appreciate it. Rochelle, back to you.
All right, Brian and Julie, great stuff there for us out there in Davos. Hope you're staying warm out there and be safe. All right, well, shifting gears, Elon Musk set to face trial today over tweets he made in 2018 regarding the possibility of taking Tesla private. Yahoo Finance's Alexis Keenan is following the story and joins us now for more. Hey, Alexis.
Hi, Rochelle. So this case is happening in Northern California in a district court, a federal court there, and it's slated to kick off at about 11:30 a.m. Eastern time today. And what's going to happen first is jury selection. So we'll be watching for what transpires. Hopefully a jury will be selected and this case will get moving along. Now here, this is a shareholder action. This is Tesla shareholders bringing this action against Elon Musk and the board, originally Tesla's board, alleging billions of dollars in damages over that 2018 now infamous tweet that we have all become so familiar with, where Elon Musk had said that funding was secured to take Tesla private at $420 a share. That was on August 7th of that year. He went on after that to say that investor support is confirmed and that the only reason why the deal was not certain is because it was contingent on a shareholder vote. Now, specifically, the class of plaintiffs here, they're shareholders in Tesla who bought or sold the shares over a 10-day period in 2018, starting on that tweet day 8/7, going to the following week on August 17th. At first, the stock on that post had jumped, but within days, it had dropped from about $25 a share to about $20 a share when no deal materialized there. Now, this case is considered to be somewhat of an uphill battle for Musk, particularly because last year in a preliminary ruling, the district judge in California said that these statements were both false and reckless, at least part of the statements the judge said. So that's already been held by the judge. That makes it difficult for Musk here. But nonetheless, he has also produced some evidence in the case showing that he was having talks with Saudi Arabia's public investment fund. So he is going to be using that expectedly as part of his defense. Still, though, that's not the only case involving this tweet. The SEC also brought a civil action against Musk and Tesla. They settled that matter, each paying $20 million in fines. That Musk is also contesting right now in an appellate court, wanting to undo part of that accord. But we will be watching and listening in the courtroom, and we'll bring you the updates as we have them this afternoon. Rochelle?
I mean, you have to wonder if we'll see any more of these costly tweets after this. I mean, this is very sobering indeed. Alexis Keenan, thank you for getting us up to speed. All right, time now for our chart of the day, and we're looking at the rise of global electric vehicle sales. Now, according to data from LMC Automotive and EVvolumes.com, global EV sales made up roughly 10% of every new car sold around the world in 2022. Now, global sales of fully electric vehicles totaled around 7.8 million units, an increase of 68% from 2021, and it's expected to reach nearly 11 million this year. All right, well, General Motors is revving up its EV offerings. The auto giant has announced its first ever electric Corvette. The E-Ray will be released later this year, starting at a price point of $104,000. Now, the hybrid EV will be the first Corvette to get all-wheel drive and will have a brand new wheel design. This rollout comes as GM works towards its goal of electric-only sales by 2040. That's lovely. All right, coming up, assessing the damage. Goldman misses the street as results season continues to give us a window into how deep the economic slowdown goes. But what's the Fed going to make of it all? We get into that conversation next.
Here we are at the World Economic Forum, the Congress Center, where all the action happens, all the sessions is right behind us, as is our studio on the roof of the Congress Center.
Julia, I think 7 billionaires just passed me and talking about the rise in interest rates and inflation. I think they can handle it.
Well, today is the second day of bank earnings. Profits fell sharply at Goldman Sachs and Morgan Stanley. Meanwhile, Fed officials are gearing up to speak on the economic outlook for the year as the central bank leans towards a 25 basis point rate hike in February. We're here to discuss is Waddell Associate CEO David Waddell. Good to see you. So we know that with every positive data point, at least that signal that the Fed might be starting to take its foot off the gas, we saw the markets rally. But where are we now in this conversation?
Well, good morning. Thanks for inviting me on. This conversation is going to evolve, but it's going to be predicated on what's going on with the inflation data, right? And so we'll get unemployment numbers once every month. Along with that, we'll get average hourly earnings, and that will dictate policy. But the communication from the Fed has to continue to be suppressing for the markets because they use communication as a policy tool. And right now they're trying to get inflation down. So I hear the communication. They are all, harmonic on it that we're going above 5%. It's going to be higher for longer, but ultimately the policy is going to be driven by the data releases. The most recent data release, of course, being friendly to the markets because earnings rose less than people expected, and that brought down the expectation of interest rate hikes, even introduced cuts at the end of the year.
So then, as people look at the correlation then between inflation and earnings, what are your expectations for the rest of the year?
That's really interesting. So last year, earnings were probably up 5% and revenues were up 10%. So you can say that the earnings were really lifted by the inflation. This year, revenues are expected to only be up 3% and earnings are expected to be up 5%. Now, whether that's a true number or not by the end of the year, who knows? But what it tells you is that companies have benefited from inflation. Now they're not going to, which forces them to pull out their scalpels, start slashing costs, start slashing payrolls. And so this year will all be about cost cutting. Last year was all about pricing power, and you get to earnings, both ways, but one of them requires a whole lot more management sort of strength.
So David, obviously there's a lot of noise out there, a lot of different data points that people are trying to follow, trying to make predictions. What are you focusing on? How do you sort through the noise to focus on what's actually going to be driving markets this year?
Well, I spent a lot of time preparing for you this morning, and what drew my attention was the Chinese GDP release this past week, and then the fact that, the natural gas storage facilities are 86% full in Europe, and it looks like they might even skirt a recession. So in the US, we've got a Fed hell-bent on putting us in recession, but in China, you've got reopening growth. Europe looks more towards Asia. It could be that actually that economy in the third quarter grew faster than ours. Most people don't know that. PEs are low, expectations are low, the dollar's rolling over. And so the offshore trade that's outperforming this year could be in its early stages. And so while the US data points matter, I would remind your viewers not to ignore the international data points. And some of those international data points are decidedly favorable.
And a lot of these growth predictions that we're seeing are really predicated on the pace of China's reopening. Is there anything that you think we're missing in the picture when we look at this rate rising environment that we're still in, but we also look at some of these geopolitical issues and China's reopening as well? How should people be viewing this period?
Well, right now, if you look at the sentiment surveys, both among fund managers, investment advisors, and retail investors, we're going into recession, earnings are going to fall, market's going to fall, test new lows, bottom in the first half and go up in the second half. Now, consensus is not always wrong, but that's a whole lot of people involved in one trade. And so what's happened so far year to date, and I'm really frankly encouraged. I know the bank earnings, specifically Goldman Sachs, were lame today, not a surprise. But I'm encouraged that the market is really kind of holding in around this 200-day moving average level, at this 50-day moving average level. If earnings this quarter don't end up negative, or they end up being less negative than people think, then that might signal that companies are up to the task to handle sort of a growth slowdown in the first couple quarters of the year. So I think people are probably too bearish, which leads to this rapid rise in markets as seller's remorse sort of brings in. But we still got a lot of people that are saying, nope, we're going back to retest the lows. What if we're not?
I mean, and we'll still see the VIX is under 20 at the moment. A lot of people wondering what's going to happen with the consumer. You have rent inflation, we're looking at even things like the price of eggs. Inflation coming down, but not at the pace that a lot of people want to see. Where do you see opportunities in this environment?
I think this is a very different scenario, maybe, as the Fed tries to engineer a little higher unemployment. And here's why. When you had COVID, everybody just fired relentlessly, right? We went to an unemployment rate of 22% overnight, and that was frontline workers. Now we're past that. It's been very difficult for companies to pull in frontline workers. They've had to pay them more. And this time they've got to reduce staffing levels. They may take a look at some of their executive staff, some of their administrative staff, some of their corporate staff, and say, we could streamline operations here. There's way too much corporate bloat. So you could reduce staffing levels at the top of the pyramid rather than the bottom of the pyramid. And that would do a lot, actually, to bring wage pressures down. So I'm not really expecting some sort of employee purge like we normally see in a recession, because this one is no surprise. They've had plenty of time to think about it. And so we may see more of a decrease in wages per unit of unemployment than we've seen in the past, which would be hugely productive. So if you look out, into 2024 earnings, 250 on the S&P, up from potentially 200 this year. To me, that's because there's being operating leverage built into the models as companies get more efficient, the economy gets more productive, because we've had a whole lot of time to prepare for this coming downturn.
Indeed, a long transition indeed. Waddell & Associates CEO, great to have you. David Waddell, thank you for joining me this morning. All right, coming up, roadblocks. Microsoft is reportedly bracing for an antitrust warning from the EU over its bid for Activision Blizzard. Is the deal facing too much scrutiny to get over the line? We ask a man who knows next.
Meta just canned 10,000 plus people, yet they have a big presence here at Davos. Julie, maybe I shouldn't be so surprised.
Yeah, maybe not. I mean, that was one of the questions we had coming into this about whether tech companies would still have big presences in storefronts here on the promenade. And the answer is they do.
Well, speaking of big tech, it's been almost a year to the day since Microsoft announced the deal to acquire Activision Blizzard. The buyout would make it the world's third biggest gaming company by revenue, behind Tencent and Sony. But since then, the tech giant has faced a series of challenges to the proposed deal, not least of which from the FTC. But is there more opposition ahead? Yahoo Finance's Dan Howley has the details. Hey, Dan.
Hi, Rochelle. That's right. The EU is preparing what's called a statement of objection. This is according to Reuters. And essentially what that means is they're going to be providing Microsoft with information on what they don't agree with as far as the potential $69 billion Activision Blizzard acquisition. Now, that deal would give Microsoft the ability to produce and publish Call of Duty games, as well as games like World of Warcraft, Diablo. Sony, huge objections to this, as well as Google. The reason being is because Sony, in its own right, relies on sales of Call of Duty. They don't want Call of Duty taken off of the PlayStation platform. Now, from a business standpoint, it wouldn't make sense for Microsoft to do that at all. They would be cutting off their nose to spite their face just because of the sheer number of gamers there. Call of Duty made $1 billion in its first 10 days on the market recently. So it doesn't appear that they would end up taking it off the PlayStation platform. What Sony seems to really be concerned about is Microsoft's ability to put this in the cloud and put it on its own cloud gaming platform, which is under its Game Pass subscription service. Sony has its cloud gaming platform of its own. Microsoft's, though, is just beating it out as far as overall offerings and, frankly, performance. So Sony's objecting to it from that perspective. You can get the same sense from Google as well. While they're sunsetting their Stadia service, they still have the back-end technical capabilities to run a cloud gaming platform, and they're going to be offering that to third-party partners. So that means that another gaming company could come in and start using Google Stadia technology. So you can understand why they would be objecting to this kind of deal, because it would give Microsoft a significant leg up in the cloud gaming space, which is still nascent, but expected to be rather large in the coming years. So now we have the EU, we have the UK, as well as the US, all seeming to lodge objections to this acquisition.
I mean, it's understandable given where the future of gaming is headed. Everyone wants to make sure they have a stake in it. A big thank you there, Dan Howley. All right, well, cracking down on big tech has been a part of President Biden's strategy since entering the White House. But there's one group that continues to cause concern among citizens and policymakers alike, and that is TikTok. Parent company ByteDance has spent years negotiating with federal agencies as fears continue to swirl over its use of data, the potential for the platform to be weaponized or even used as an arm of the Chinese state. A federal crackdown has started, but where could it go next? Yahoo Finance's Ali Garfinkel has all the details. A long and winding road when it comes to TikTok, Ali.
A long and winding road indeed, Rochelle. The government has sort of put TikTok between a rock and a hard place. However, it hasn't decided what it wants that hard place to be exactly. There are sort of a couple of options sort of playing out right now on the federal level. The first is from Congress, the theoretical all-out ban that's been put forth by, among others, Senator Marco Rubio. However, I've talked to a bunch of experts, and they've all said the same thing. A consumer ban on TikTok is highly unlikely, if not impossible. Which brings us to, well, if Congress can't do anything, where does that leave President Biden, for instance? And the answer is unilateral action from President Biden is possible. There are some precedents for that sort of thing, but they aren't direct. But even in the end, I'd say a signal from the White House is something that I think a lot of people are waiting for. Ultimately, investigations are still carrying out on this federal level. Of course, the most famous is the Council on Foreign Investment in the United States investigation, CFIUS, which has been incredibly protracted. It's been going on for, I believe, almost 2 years, if not 2 years exactly. I think it's worth looking at TikTok's response to this, Rochelle, as well. Their response was actually not what I was expecting. It was the idea that a ban on TikTok would be piecemeal. Actually, the idea that they want to keep engaging, they want a plan, they even have a plan, and that a national privacy law is actually what solves the problems they're talking about, and that the problem they're worried about is ultimately bigger than TikTok. Looking forward, I would say watch for corporate pressure, because that's an area where things can get done immediately. We only need to look at, say, what happened with Fortnite when it was banned from the Apple Store. I'd say long term here, we're still watching this one play out.
Indeed. We know big tech already in the crosshairs for regulators. Ali Garfinkel, great update there. Thanks so much. All right, coming up, expanding the footprint. CVS has made some big moves in the primary care market in recent weeks. We'll speak with a company it's partnering up with in a bid to shake up that space. That's up next.
Welcome back to Yahoo Finance Live. I'm Anjali Kimlani. Startup Carbon Health is partnering with CVS Health to bring its primary and urgent care services to select retail stores after receiving a $100 million investment from the healthcare giant. The boost comes at a time when Carbon is right-sizing its business. And here to break it all down is Carbon Health CEO himself, Aaron Bali. Aaron, thank you so much for joining the show today.
Thank you for having me.
So there's a lot going on at the company. Let's break this down first. So the company gets its name on the map during the pandemic. You stand up testing sites, everything going well, money flowing in, investor sentiment high. And now you're in a position where you've had to right size and downsize in the past several months. So talk to me about why you're pulling out from the verticals you are and how you are balancing everything out with this CVS partnership.
So we built a very ambitious plan in the last several years where I think I had communicated the goal was to become a nationwide primary care provider by 2025. And we started expanding very fast in the last several years. But our growth at the end of the day requires capital, access to capital. And when the capital markets crashed this year, we had to change route and open fewer clinics, slow down our growth, pretty much completely a reaction to public markets.
And noticing on that map that you just saw, you're in 13 states now, you have physical locations there. You also were looking at chronic care as one of the verticals, as well as remote patient monitoring. That seemed like something that came as a result of the pandemic. So tell me why you've chosen to stick to primary and urgent care versus, moving up on those scales.
It was mostly a result of the fact that if our clinics don't grow, we don't have as many clinics, we won't have as many patients to be able to have specialized programs. So what we end up doing is we took the capabilities we built and brought it back to our primary care service. And that's in line with actually the way healthcare ecosystem is going. So essentially we are doubling down on value-based primary care. So instead of having chronic care management programs as independent services, we bundled all of those back to our primary care offering, and we have value-based care partnerships so that we don't have to monetize them directly. Instead, we are monetizing them through our primary care service.
I'm going to take a stab here and wonder if it's related to what you said in the statement with the CVS agreement, which was, quote, while healthcare has evolved tremendously over the past few years, there's still many ways in which care delivery and quality have not. Tell me the ways that they've not. Is this mostly on the payer side you're finding that it's harder to really move the needle?
I would say in payer side, there's a lot of friction to provide the more innovative forms of care when you have to go through a fee-for-service model where we have to bill for every interaction we are coming up with, versus there's a new model called value-based care, which has been around for a long time, but still hasn't been adopted as widely as we would hope. In that model, instead of getting paid for every service, you get paid a lump sum amount, and then you have more freedom to provide the type of services you want to provide. So we think that's actually very critical to unlock the type of primary care we want to provide. We call this connected care. So the idea is, while traditional primary care providers really rely on visits, we believe everything that happens in between visits is really what everyday healthcare is about. We do things like logging symptoms and setting goals, using devices to track data in a longitudinal way. We have a lot of non-traditional forms of care, which is hard to monetize through traditional insurance billing process.
I know, I was kind of sad to hear about the chronic care part. I feel like that's so sorely needed in the country, but hopefully you can get back on track there. But let me ask you about electronic health records, because I know that that's something that you were discussing as late as December. Where are you with that? Do you still see technology licensing as an avenue for the company?
We definitely see it as an avenue. We built our entire technology platform, the EHR, patient app, everything as a single technology platform from the ground up. And when we look at other tech-enabled service providers, we sometimes replace 13, 14 different tools they're using with just a single technology platform. So we are already in a lot of conversations, and that is definitely going to be a huge growth area for Carbon Health.
Sounds good. Well, we'll have to leave it there for now. Aaron Bali, Carbon Health CEO, thank you so much for joining us. Stay tuned. Yahoo Finance Live will be back.
The World Economic Forum is fully underway with the great and the good of the world of business, finance and policy making gathering in Davos, Switzerland. Let's get to the great Yahoo finances, Brian Suzy and Julie Hyman, who are on the ground there. So guys, set the scene for us. Your biggest takeaways. What stood out for you so far?
Take it away, Julie.
Well, you just asked for a little weather report. It's 19 degrees, but if you're in some of these conversations with some of these world leaders and CEOs, they're raising a lot of red flags about all kinds of issues, right? There's the big sort of long-standing stuff like the climate crisis. There is, of course, the Russian invasion of Ukraine, which is ongoing. We had the chance earlier today to speak with the mayor of Kyiv, Vitaly Klitschko, and you're going to hear more of that interview on Yahoo Finance. So there's these sort of big overhanging issues, but then there's individual companies, individual countries, and they seem to be striking slightly more of a positive tone, or at least a less pessimistic tone. Even the Chinese Vice Premier Liu He, who came sort of last minute to the conference, he wasn't quite as negative. Even with the Chinese economic readings today not being great, he wasn't as negative perhaps as he could have been.
Right, and as for me, my two top takeaways are this. I've never felt more old than at this World Economic Forum. And I mention that, guys, because there is a new wave of technology coming. There's so much focus on Microsoft and its affiliation with ChatGPT, but there are programs like that coming that are going to fundamentally change how we broadcast, how we invest, how we communicate with each other. And it is not written in stone yet that an Amazon, a Microsoft, and a Google will be the dominant players in here. Now, I will say it may be interesting to see if those players with big cash coffers go out and buy this next generation of AI technology and add it to their systems. If you're a Mark Benioff at Salesforce, do you go out and buy some of these platforms and integrate it with the Slack? So that is very interesting to watch as well. Then, of course, a lot of recession talk here as well. The little more gloomier World Economic Forum than in the past. And now, for me and Julie, it's party scene. We're going to get out there and network, do our thing, drink some wine, and book some interviews for the next 5 years.
And you raise a good point. When you think about sort of this next evolution of tech, when you think of where OpenAI was just a few years ago, and look at where we are now. Now you have a lot of companies clamoring for it. Think of, when BlackBerry was at its peak and now, where it is now. What do you think this is signaling about where things go from here, what the next evolution of tech might look like?
Well, what's so interesting is, AI has been a conversation for years, here in particular, where there's been debates about the ethics of AI at past World Economic Forums. But this is the year that I think for most individuals, it feels more real because you do have a product like ChatGPT out there, because AI is becoming more integrated for the first real time in our lifetimes. And so in terms of what's that going to mean, I don't think we can even conceive of what it's going to mean, not just for us on a consumer basis, but for example, we talked to Mark Sussman of the Bill and Melinda Gates Foundation. They're using predictive AI to help small farm holders, right? Small farmers to predict weather patterns better, to know when to plant better. And all of this stuff it's on the cutting edge, but it's also here in some respects.
Yeah, and it also means, Rochelle, that the world is going to move even faster. Conversations are going to happen even quicker than they do now, and you're going to get access to more information. And then on top of that, I think a lot of this OpenAI technology is in part of focused on getting our own information back. We're no more necessarily giving our data to a Facebook so they can sell it and make money off it. We will, in some respects, own this data, take control of it. Now, we may be paying a subscription to some of these services, but still, we start to take some of our own data back.
Incredible possibilities there. Thank you for getting us up to speed on what's been happening there in Davos. Brian and Julie, thanks so much. We'll be looking forward to more of your coverage this week. All right, well, before we go, we're going to do a final check of the markets to see how they're faring as we head into the noon hour. Still a mixed picture there. You see that the Dow off about 1%. They're still dragged down by what we saw from Goldman Sachs' earnings and their dismal forecast, what we saw with earnings per share. S&P also dragged down, but just slightly, down about 3 points. And the tech-heavy Nasdaq in the positive for once, up there about almost 9 points. Well, that'll do it for us. I'm Rochelle Akufo. See you tomorrow at 11 Eastern.